In New York City on this Tuesday, November 26th. Welcome to Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, global stocks take a hit. President-elect Trump makes his first specific threats on tariffs. After the Dow, the S&P 500, and the Russell all hit new records, U.S. equity futures pairing losses sparked by Trump's vows for an additional 10% levy on goods from China and 25% on products from Mexico and Canada. Now, the U.S. dollar staged a rally while the Mexican peso and the Canadian loonie were among the worst performing currencies. Shares of automakers also taking a hit as analysts, they say that the tariffs would place a bullseye on the industry. Ford, GM, Stellantis, and more are all lower pre-market.
Plus, investors turning their focus to the Fed. The release of the November FOMC minutes later on today, which could provide some clues onto whether or not the central bank is going to cut rates come December. Inflation, productivity, and the Fed's long-term neutral rate will also be in focus. Citigroup is at odds over what the Fed should do next. Its interest rate strategists say that the Fed should pause rate cuts, while the bank's economist team are still holding out for a half-point cut in December.
And Intel securing $7.9 billion in U.S. federal chip grants. The struggling chip maker is receiving the largest direct subsidy from the CHIPS Act funds, but getting less than an earlier proposed award. Specifically, Intel will get money for projects in Arizona, Oregon, and New Mexico, according to Bloomberg. Meanwhile, Qualcomm's interest in buying Intel, it's cooled. According to reporting from Bloomberg, a deal between the two companies would likely have been one of the largest ever in technology. U.S. stocks pairing initial losses sparked by Trump's pledge for additional tariffs. They're taking a look at a mixed equation as of right now for the Dow, the S&P 500, and the NASDAQ. However, the announcement sparking volatility in currencies and sectors poised to be impacted by tariffs. Hey, look no further than retailers and the auto industry. There you're taking a look at the U.S. automakers. Ford, General Motors, and Stellantis are all down as of right now here. And then additionally, some of the retailers, no doubt, acknowledging what type of impact that this will have on their business too, given some of where the imports and products come in from.
Yeah, the big question is it's unknown of how much of this is going to be a negotiating tactic versus how much of this is going to come into fruition. And I think that's what the market is debating out this morning. This is significant just given the fact of how much we do import from these countries. And we have a graphic if we could pull that up. Mexico importing goods that we import from Mexico, just around $378 billion. When you compare that to, this is actually the 2023 number, so a bit different. I was just doing those year-to-date numbers. So 2023, we imported $476 billion from Mexico, $427 billion from China, $421 billion from Canada. So far this year, Mexico, we've imported the largest, followed by China and followed by Canada. So very similar to what we saw last year back in 2023. The last time Trump did wage a trade war, trade tiff, if you want to call it that, the markets were clearly on edge. We saw currencies take a hit. That was back in 2018. Into December of 2019. We certainly saw those ripple effects play out within the market. So again, it's very unknown as to whether or not this is actually going to be implemented, whether or not it's more of a negotiating tactic. But you can see the markets once again on edge, and you can see that reflected in the early moves here this morning before the bell.
Yeah, absolutely. And starting to come up a little bit more in some of the earnings calls as well. As we've continued to hear from the retailers over this portion of the earnings season, this subsegment of the earnings season, that has come up either on earnings calls, both proactively and reactively in some of the questions that we've heard from analysts on those calls with regard to how they are trying to pull forward inventory in some measures to make sure that they're able to at least outlast or make sure that they have enough as of right now in the face of whatever tariff implementation might take place early next year.
Well, Trump's tariff announcement, a reminder to investors on the market volatility that can come with the second Trump presidency as a bounce fades, at least for now. We want to bring in Brian Nick. He's a New Edge Wealth head of portfolio strategy. Brian, I'm curious what you're making of the headlines that we've gotten out over the last 24 hours.
Yeah, it was sort of a flashback to the late 2010s when you could be on social media and you get these flash announcements and pronouncements from Trump that he's going to put these tariffs on. And
it would wake me up in a cold sweat, Brian. know.
Got to dust off my graphs of trade policy uncertainty and volatility correlations. But I think you guys put it really well. There's two questions here. One is what would be the impact of these tariffs if they were implemented, and then second, what's the probability that these tariffs are going to go forward as announced? And it's going to take some time. It's not a day one thing, right? There's a review period. There's a commentary period. I think the markets are able to look through this, expecting that maybe, in a kind of a broad-based sense, there's not going to be, quite as severe a tariff put on, especially Canada and Mexico, as the announcement. But I think if you're a company, an individual firm that relies on imports from these countries, these very, very large trading partners that we have, you probably have to start reacting now. You can't afford to wait and assume this isn't actually going to happen. So it makes sense that you see the price reaction in the car manufacturers. There's so much back and forth. A lot of times these cars are like imported and exported multiple times as they're being built between Canada and Mexico. So it's insanely disruptive to have this uncertainty hanging over. And you may see stockpiling of parts, component parts, big businesses, but also small businesses that have to pull forward some of their purchases into Q4 because they don't want to wait to see how expensive it might be in Q1.
What do you think the effect of that stockpiling is, especially if you were to pull forward the purchases? You're pulling forward an expense or a cost of goods and services as well. So how does that factor into outlooks that we still have yet to hear from some companies, but for some that have already reported this earnings season, they might already have to start factoring that in, and we may even see some revisions come out too.
Yeah, I mean, there's two things here. One, just mechanically in GDP, Q4 might be a little bit higher if you have a lot of inventory stocking pulled forward, and that might mean Q1, Q2 are a little bit weaker. So you might just get a little bit more volatility in GDP. But I think the other thing that might happen is if you get a lot of demand suddenly for a limited number of goods that maybe Canada is producing, it's harder to stockpile things. A lot of things we import from Mexico are perishable, so you can't stockpile tomatoes and fruits and vegetables and things like that. But the things that come from Canada, if there's a big rush of demand, that could push prices up too. And what you saw in 2018 is a lot of times the price reaction in the individual goods that were being subjected to the tariff would happen before the tariff went into place because the anticipatory demand would cause a spike in those purchases.
Brian, when it comes to the strategy, I guess how investors should be thinking about this, what should they keep in mind, just given the fact that there is so much uncertainty and so many unknown variables in terms of how this is actually going to play out?
The two things that trade policy uncertainty specifically do is they create volatility in equity markets. They create dispersion in individual sectors, winners and losers, because there's very concentrated losers in a lot of these scenarios. But what we tend to see is that the volatility associated with trade policy uncertainty is not a zero-sum game, that you end up with less investment, lower GDP growth than you would get otherwise. And that means that we want to be positioned somewhat more defensively. We were already anticipating slower GDP growth, slower earnings growth in the S&P 500 and Russell 2000 next year. I think that what we are likely to get as a result of these tariffs and the uncertainty they create is more of that. So we're positioned defensively. We have in fixed income, we are overweight the longer duration parts of the curve. You actually haven't seen bonds rally, which is interesting. I think there's still some ambiguity about how people feel like these tariffs are going to affect interest rates and what the Fed needs to do. But on the equity side, we're also positioned more defensively, emphasizing profitability, quality, and not chasing a lot of the kind of the junkier names that have been leading the rally the last couple of weeks.
On the other side of this, if it's not as bad as it could be, does that just initiate some massive relief rally?
Potentially, but it doesn't look like the markets are going to open down that much. Overnight, there was a dip, but I think in terms of the individual sectors being affected, yeah, you could get, it's almost like, bending a hose and then letting the hose go.
Right.
You don't end up with more water, you just end up with different velocities at different times. So I think it just adds to the choppiness, the churn that we already thought was going to be sort of characteristic of the equity market next year, but this just adds to it. And I think by no means should we expect this is going to be the last one of these kinds of announcements.
Brian, when it comes to, I guess, the odds that we're going to have a Santa Claus rally, what exactly that looks like going forward? There certainly was optimism. Does this at all change that calculus or no?
I don't know if consumers are going to be that focused on this particular issue yet. I mean, anticipating that in February or March you might have to pay more for fruits or vegetables. We already know that people are very skittish when it comes to grocery price inflation. This would make things worse, but I think unless and until they actually go into effect, I don't think you'll see a consumer response. You are already seeing a little bit of a mixed bag, and a lot of these companies reporting, like one day you get Walmart with very good reports, one day you get Target with not great reports. we think that the jury is still out on the consumer for 2025. It looks like we're going to have a pretty good end of year shopping season, but with the labor market softening, with wage growth declining, I think the thing that's really keeping the consumer alive right now is there's definitely animal spirits associated with higher equity market valuations. People feel wealthier as the value of their nest egg, their 401k has gone up, and that is one of the things that drives people to decide to save less and spend more. And until we see an equity market shake or decline or some kind of correction, I think consumers are going to still feel pretty confident about their ability to spend.
You know, it's so interesting, and I don't want to jump the gun here, but I'm going to jump the gun because I was speaking with the Smucker CEO, and we're going to break down earnings a little bit more. But one of the things that was interesting that he told me was the discretionary spend that consumers are really being more diligent about and asking themselves, even in the grocery aisles, hey, do we need that extra discretionary snack? Do we need that thing that is not just the absolute nutritious thing that is necessary for us to have in the pantry or in the refrigerator? How do you think that mindset really permeates through into some of the names in the market as well, and those that are set to best positioned to outperform versus others that are a little bit more vulnerable to discretionary spends?
I think this is particularly true when you're looking at sort of we call the kind of the K-shaped consumer right now, where you have some consumers who are at the lower end who are doing more of what you're talking about, or spending less, are having to maybe decide between making a large goods purchase and maybe taking a trip or something else. And then there's people at the higher end who are more reliant on their wealth and their feeling of security that they can continue to spend at the rate they've been spending. And to the extent that becomes more of an issue, you could actually see some of the lower end consumer names continue to struggle. Some of them have, like Dollar Tree, because those consumers are making the cutbacks and the higher end consumers aren't necessarily at this point. I do think, though, when you look at things like the savings rate being as low as it is, that reflects decisions on the parts of consumers. When savings rate starts to go up, that's when we start to worry. It's a little bit counterintuitive. You think as people save more, that tends to mean the economy is slowing down and consumers are becoming a little bit more cautious about what they're doing. So if we see that in the numbers we're going to get tomorrow on PCE and we continue to see it, that's going to be a sign that you should expect slower consumer spending next year.
Interesting. Brian Nick of New Edge Wealth, thank you so much for taking the time here with us.
Thanks for having me
this morning. Appreciate it. All right, let's stay in the retail landscape, why don't we? Kohl's lowering its annual forecast after reporting weaker than expected third quarter results this morning. The retailer citing weakness in apparel and footwear. And this comes after the company announced its CEO will step down in January after less than 2 years in the role. Joining us now, we've got Zach Waring, who is the CFRA analyst. You're lowering your price target on Kohl's. What is the core driver behind that change?
Yeah, thanks for having me. We think the decline in shares this morning are pretty much warranted. You've got a company that's not operating well and hasn't been for a couple of quarters now. And now they're going to go through another CEO change in January. So, we think the next 12 months are going to be bumpy for the company. We do think they can earn, roughly $2 a share next year, which is going to be up from this year. But, even with that, we think, 8 times, forward for that number is fair. And, we think with a new CEO, you've got to kind of wait. You're going to have to wait 12 to 18 months before you start to see results there. So, overall, we thought the quarter was pretty bad. Lowering guidance, miss on the quarter in terms of EPS and revenue. And so, full year guidance, they're lowering pretty drastically, well below analyst expectations. But and so you see a 20% decline in shares, and we think that's warranted.
Zachary, when it comes to the fact that you think it is warranted here, the new CEO that was named, Ashley Buchanan, he's coming from Michaels. He's been successful there. Is that the right person for the job? And I guess when you talk about that turnaround, what does that timeline look like?
Yeah, I think he's a good candidate. He's a Walmart veteran, did some time at Walmart and Sam's Club, and then now, at Michaels most recently. He's going to inherit pretty easy comp. So, he's going to have, this is a pretty down year. It's been 2 down years for Kohl's now. So he's, inventory is probably right size now. So he's inheriting, at the bottom here. So I don't think he's got very high expectations, which is always good for a new CEO. But yeah, it'll be interesting to see, how he takes over this company. He's worked at companies that have been successful. But now you're inheriting kind of a Kohl's that's facing a lot of long-term headwinds as a department store. So it'll be interesting to see how this works out.
Zach, how ugly is the holiday quarter potentially going to look?
Yeah, so, we think the holiday quarter is going to be stable. The NRF, National Retail Federation, thinks 2.5% to 3.5%. Most of that growth is going to come from online retailers, which doesn't help the department stores much. I mean, they do have an online business, but, they're not by any means the majority of their business. So, we think apparel and footwear is going to be pretty soft. We think flat would be good for the year. And then, we think obviously online will lead kind of in line with the NRF expectations.
Zachary, while we have you, we've been rounding up some of the commentary that we're hearing just with regard to the impact of tariffs on this industry and more broadly as a pass-through to the consumer mindset and inflation more broadly. Just want to play this and get your reaction on the other side.
Tariffs are inflationary for customers, but we want to work to bring down prices.
And it's an ongoing conversation with our business partners, our manufacturers, our suppliers, and making sure that they're thinking about, obviously, if something can be made outside of China, that's going to be advantageous. If you can at least balance your production into another country, that's also going to help.
We've built a plan around supply chain to continue to mitigate and reduce our China exposure. I mean, 10 years ago, even 8 years ago, 40% of what we sold in the U.S. came from China. Today, that number is about 20-25%.
And so, Zachary, all of those comments rounded up, I'm just wondering how you're quantifying the potential impact of tariffs on some of the businesses that you cover.
Yeah, I mean, I think apparel is going to be hit the hardest. Most apparel is made in China, or a lot of it for that matter. Some companies have moved supply chains away from China, but it's kind of hard to avoid China, completely. So, I think, in terms of apparel, it's definitely going to be a hit. But maybe, a 10% bump is not maybe as much as people expected. So it'll be interesting to see how these companies trade over the next few weeks. And then in terms of footwear, a lot of footwear has moved out of China, to Taiwan and some of the other Southeast Asia companies, our countries. So it'll be interesting to see how they trade over the next few weeks. We do think there will be some sort of impact. But, with only a 10% bump, we don't think it'll affect these companies too much.
There's been so much focus on Shein, Temu. Do you think that Shein, Temu, the countries that are really importing and exporting the most between the U.S. and China, see the most impact? And does that, dare I say, kill fast fashion or at least put a major dent in it?
Yeah, I mean, I do think it makes it harder for the lower cost goods. So like you said, those two companies try to target lower cost. And so, with the 10% bump, that makes a big difference in terms of margins for those companies. Whereas if you get some more of these, higher end consumer products, a 10% increase does hurt, but it's not as big. So, we like luxury brands here, a lot of luxury brands, they make their goods in Europe. So luxury should do well over the next 12 months and kind of avoid some of those tariffs. Now, we do know that Trump has said that, no one's really safe in terms of tariffs. So, and that's been proven already with Canada and Mexico tariffs. So, it'll be interesting to see what he says about Europe and if he's going to put any taxes on there.
All right, Zachary Waring, CFRA analyst, thanks so much for hopping on with us this morning.
Thanks.
Coming up on a morning brief, we're going to count you down to the opening bell on Wall Street stocks pairing tariff-induced losses. Plus, hone in on tariffs and what it means for the global economy and the Fed. And we bring you the latest on a slew of retailers out with results today. All that and more coming up on Morning Brief.
You're watching Morning Brief, brought to you by Invesco. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Hey, first up, let's talk a little Best Buy, cutting its full year sales forecast after missing quarterly expectations. The CEO citing macro uncertainty and distraction ahead of the presidential election for weaker demand in the third quarter. Shares pre-market lower by about 6% off of this earnings report here. And of course, as we're waiting for more commentary to come forward from the leadership during that call, one of the huge things to remember is that this is not the only company that said that there was some choppiness in the consumer mindset. We heard that early on in the earnings season from Delta CEO Ed Bastian, who was talking about that choppiness and some of the pensive spending here, waiting until after the election for consumers here. But more broadly, I think one of the issues that Best Buy continues to struggle with is the fact that, hey, as long as we're seeing this type of housing market dilemma more broadly, then less people are going to need to purchase major appliances or purchase a new TV or a lot of the things that really stock the shelves of Best Buy.
Yeah, and I think it also shows that a lot of people are holding off on some of their purchases, right? They're waiting for the Black Friday deals, me included. I'm one of those people that have held off
what you getting?
on certain purchases, not necessarily from Best Buy, but just overall when it comes to things that you're getting for the holiday season, whether or not it's for your kids or gifts that you're giving loved ones or friends or colleagues, whatever it is. A lot of times, at least for me, you wait for the deals. And so I don't necessarily think that this is a huge surprise given the dynamics that we're seeing and given some of the macro pressures that we have been seeing more broadly. But again, I was just taking a look at the quick reaction from the street this morning. The analyst over at JP Morgan saying that this was a somewhat soft overall quarter, talked about the fact that the results are not worse than feared, with encouraging signs, though, to start the season after a weak second half of the third quarter. So again, it's not all lost, it sounds like. There is still some hope for this current quarter right now, for the holiday quarter, once people are back buying and putting some of that money to work. But again, to the extent of it and how much that can carry over into 2025 is very much in question.
Yeah, balancing.
You don't wait for the deals?
I don't need any deals. I'm all set.
Are you just not purchasing in general?
No, all of my things work right now. They're all running extremely well. The refrigerator is just fine. The TV, just got it from Best Buy a couple years back. Loving it. It's a great experience. The quality, high def, as promised. So as long as it's delivering, I'm good. I'm all set. You won't see me there busting down any doors.
All right. Save yourself some time and some money. All right, next up, let's take a look at Dick's Sporting Goods raising its full year guidance after topping third quarter earnings estimates. The CEO touting a strong back to school shopping season and an upbeat outlook heading into the holidays. So a very different tone that we're seeing and the reaction that we're seeing from the street here to these results. You're looking at a jump of nearly 8% here, potentially, as we look ahead to the opening bell. When you take a look at the fact that they did boost their annual guidance, some indications of the strong start to the holiday shopping season. We know that is so critical here for names like Dick's, especially amongst the fact that they're facing some stiff competition. They've talked about an increase in competition on past earnings calls. But again, it looks like the fact that since they are coming off of issuing some of that cautious guidance earlier this year ahead of the 2024 election, we are seeing a bit of a rebound here in the stock this morning. We'll see whether or not it holds.
Yeah, one of the stats that I had seen earlier this morning really jumps out to me, and I think it was really more telling about some of the trends that Dick's Sporting Goods is able to ride high on right now. And it was a stat from the Sports and Fitness Industry Association, where they in 2023 noted that 39.8% of children, so just about 40% of children aged 6 to 17 regularly participate in a team sport in 2023, highest rate since 2015. What does that do for Dick's Sporting Goods? Well, it just means that more people are hyper-focused on making sure that they're at peak performance level, whether you're 10 years old or whether you're 17 and trying to get that college deal, or whether it be an NIL deal, or whether you're just trying to make sure that you can make a college team and get an offer and get recruited. Everybody is piling into those opportunities to make sure they've got the equipment, that they've got the necessary gear in order to make sure that their season is going correct here. And I think Dick's is really being able to ride on some of that broader momentum here. I enjoyed those years for myself, but hope these kids are too. Social media really amping it up here for them.
It is.
Awesome. Let's go to the Uncrustables here, why don't we? J.M. Smucker raising its annual profit forecast and reporting strong second quarter results, boosted by strong demand for frozen and packaged foods. Here's what the CEO of J.M. Smucker, Mark Smucker, had to tell me.
So on Hostess, for example, in addition to the marketing and the advertising, really making sure that we continue to innovate, providing options for value where we're looking at smaller pack sizes, $1 packs, making sure that we can cross-promote Hostess with our legacy brands. Since it's a discretionary category, we can cross-promote, say, with coffee, which is less discretionary, and continue to drive revenue in Hostess that way. So acknowledging that the consumer is still a little bit stressed, inflation is definitely a factor, and they've got less discretionary dollars in their pocket. So finding ways to appeal to them differently is going to be key to success.
Just two more points to make on top of this. Number one, you're about to see a massive marketing blitz, it sounds like, for that Hostess brand, a company that Smucker's was very strategic in making sure that they acquired and integrated into their portfolio of brands here. What he also told me on the call was as they get into the new year, they're going to start stepping up some of that major marketing effort responsibly over time, trying to bring more consumer communication back here. So you could be seeing a lot more of the Hostess brands here, which means some more of perhaps the lava cakes that they've been doing some experimentation with. I was able to test while I was out there a few months back as well. And then just lastly here, the fact that Uncrustables is going to exceed a $900 million business in net sales this fiscal year here. You laugh right now. You haven't tried an Uncrustables, Shauna. You told me that. I
haven't. I know. And I think you might be the #1 promoter of Uncrustables.
Look, here's the thing. When you go out there to Orrville, Ohio, they've got Uncrustables, Nike Dunks even. They're all in on Uncrustables out there.
And why not? It's clearly working for the brand. You take a look at the sales there, like you were just talking about. I mean, it's all about convenience, and that's clearly registering here with consumers. All right, keep it right here on Yahoo Finance. Coming up next, we've got the opening bell. We'll be right back. We've got the opening bell on Wall Street. You're watching the morning brief brought to you by Invesco. Let's do a quick check of the markets here at the opening trade. We're looking at some downward pressure, at least for the Dow, off just over 100 points here in early trading. But as you can see, it certainly is a mixed picture so far. You've got the S&P opening to the upside, up just about 0.3%. It looks like inching closer and closer back to that 6,000 level. And as the NASDAQ calibrates here, we are moving, it looks like slightly here to the upside, potentially a move higher of just about 0.3%. Taking a look at the action that we're seeing play out in the bond market, we're looking at yields tick just a bit higher, right around that 4.3 level. That, of course, will be a trade to watch here today. And then also the dollar gaining some strength here. We got the news out last night about President-elect Donald Trump's potential tariff plans. That's sending ripple effects throughout the currency market. We are seeing the U.S. dollar index move slightly higher. On a sector basis, we certainly are seeing a mixed picture. You got technology and utilities among the outperformers in early trading action. Industrials, materials lagging just a bit, as well as financials. Taking a look inside the Dow, giving us a better picture of what we are seeing on that sector basis. We are seeing some pressure across the board when it comes to Caterpillar, off just about 0.1%. Goldman Sachs off about 1%. Nike, the consumer stock, off just about 1%. But take a look at many of those larger technology names. You got NVIDIA up nearly 2% at the open, and Microsoft and Apple. So again, a bit of a reversal from that euphoria that had been sweeping Wall Street as investors do react to the news out last night of President Trump's potential tariff plans. Let's kick it over to Yahoo Finance's Jared Blickery for a look at what's moving. Jared.
Thank you, Shauna. I want to go back to the Russell 2000 because what a day yesterday. I'm going to show you a 3-month chart here. And we did break to a record intraday high yesterday, but we're not able to make it to the close and post a closing record high. But this is the definition of an uptrend where you have higher highs and higher lows and just kind of zigzagging higher. It's taken a while. It hasn't been as steep as the NVIDIA gains earlier on in the bull market, but nevertheless, this is an important pattern because as I've been drawing here many times over the last few weeks, we have a large rounded base here. We might get a handle, so it might take a little bit longer, a few more months to finally break to the upside, but that's probably where this is going, although nothing is guaranteed, of course. Got to put that in as well. 10-year T-note yield had a really big day yesterday. It was down about 14 basis points or so. It is bouncing up today, but that move yesterday took a lot of pressure off of risk markets, and that was tied to that Treasury Secretary news that we were just talking about, that Shauna was just talking about. And the U.S. dollar index that Shauna was looking at, very similar story there. It's not really that much change from yesterday, but it is closer to its record highs. And I'm going to be talking about the potential for a dollar wrecking ball in the 11 a.m. hour today. And so let's go to our sector action. See if tech is still the sole outperformer. Indeed it is. There's XLK, there's the S&P 500, so it is the only one outperforming, up about 68 basis points. But I want to go over to our leaders where I've been checking out XRT. This is the Spider S&P retail ETF, and today it's taking a little bit of a backseat, but only yesterday it broke to significant new highs. These are the highest levels of 2024, not quite back to where we were back in 2021. It peaked late in that year, but nevertheless an important breakout for the retail section of the market, and that's been doing very well since the election overall. I want to get to crypto real quick, where we see Bitcoin never able to punch through 100,000 a few days ago, so it has been on the decline. It just punched through 92,000, and you can see it's still very close to those record highs, but a little bit of a disappointment for people who were expecting to wear those 100,000 Bitcoin 100,000 hats this week. And finally, I'm going to close on gold, which just had its worst day in 3 years. It's still close to its close to its record highs there, but we can see we just had a big down day yesterday. You can see that on the 1-month chart, and so kind of took the wind out of the sails of that inflation trade. Guys?
Thanks so much. Teeing up today's market activity plus some of the action that's already underway. It's time now for today's strategy session. U.S. stock valuations, they remain elevated. U.S. equities trading at a 60% premium to global stocks. But our next guest says that there's no catalyst coming to normalize valuations. Joining us now is Matthew Palazzolo, who is the Bernstein Private Wealth Management Senior Investment Strategist. Great to have you here with us this morning. So why? Why is there no catalyst in sight to normalize valuations from your perspective?
Well, look, as we enter into 2025, you have to look at the U.S. economy, and it's on fairly solid footing. The labor market continues to chug along at a decent pace. Consumer spending also chugging along at a nice clip. And so there's always risks to the economy, exogenous shock or otherwise. But from our perspective, it's hard for us to make the case that valuations all of a sudden are going to go back towards something like the long-term average, at least for now, until we get clearer evidence that there's risk on the horizon.
So Matthew, what are you doing, or how are you advising clients and moves that they should be making with their portfolio?
Yeah, so we're diversified investors. So we want to ensure that we're lining up our clients' asset allocation with their long-term goals. We continue to like U.S. equities. We have a modest overweight relative to global indices. So we're big U.S. investors. But we want to underscore the importance of being non-U.S. investors as well. Valuations, as was just said a second ago, are at a steep discount relative to U.S. equities. And there's a fair amount of concentration in the U.S. market, particularly in the S&P 500. So we want to remain very diversified by sector, by capitalization, and by geography, and also fixed income. Given the level of yields today, we think provide a particular amount of attractiveness because you can just collect yields and not even assume rates are going to move one way or the other. You can collect 4 to 5% in high quality bonds.
Matthew, going back 1 second to your valuation point there, are we due for a 5 to 10% pullback, and would that be considered healthy at this point?
It might be considered healthy. 5 to 10% sell-offs happen often enough in the markets, and so you have to assume that that's going to be the case if you're invested in stocks. But again, our models are assuming that we get earnings growth of high single digits in 2025 and into even 2026. And if you assume that valuations stay north of 20 times earnings, then you're going to get a return on the market pretty much consistent with the level of earnings growth. And so absent any other news to interrupt that assumption, and that would push valuations much lower, whether it be a recession or some exogenous shock, then I think that's the safest bet to make as we look out over the next 12 to 18 months.
As we think about what's really driven the broader narrative that has ballooned valuations to this juncture, it seems like, look, this AI thesis that is baked into a lot of portfolios and has really led an overweighting or an overcrowded trade into some of the Mag 7 and NVIDIA as the AI poster child. As we're thinking about that, do you believe that companies grow into those valuations, or there's a better chance that those valuations get tested next year, and for the companies that are not able to show investors that they're able to deliver on those return on investments and the CapEx that's being spent, that there's some shrinkage in those valuations?
That certainly is a risk. The concentration, the execution of those businesses to this point has been exceptional for many of them. That's why they're at the top of the index and has performed so well when you look at their stock prices. So that's something that we have to watch for. Again, if our portfolio managers and our analysts, it's their job to determine which of those stocks they want to own and not to own. But any investor that's overly concentrated in the names at the top of the index certainly do have a risk that if there's a mismatch in expectations relative to execution, that we could see a sell-off. Now, if you look beyond the top 7 or top 10 stocks in the index, there's obviously less expensive valuations. And so a diversified portfolio is going to own stocks that are trading at 17, 18 times forward earnings, which is much more in line with the long-term average. And so you've got some valuation risk management there by remaining diversified and not being overly concentrated in the companies that have done so well for the last 12 to 24 months.
Matthew, given the fact that it seems like Wall Street's kind of having a tough time really wrapping their heads around what exactly a Trump administration 2.0 is going to mean for the markets, just given the news that we're getting on a daily basis, is it safe to say that we are going to see this increase in volatility then going forward? I guess, what should investors be expecting?
Yeah, so I think the last 48 hours or so is a great example of what we can assume for the next 4 years and what we had a couple of administrations ago. It's a tug of war. It's a push and pull where you get market-friendly news like we did over the weekend with the Treasury Secretary naming, and then today with the announcement of some tariffs. So volatility certainly is going to be one of the key themes over the next 4 years. It always is, but I think now, given the what's going on in Capitol Hill, we can expect more of it, or more being centered and deriving from what happens in DC. And we're going to go from day to day. We're going to have good market-friendly news, and then others where that serves as a counterpoint. Look at the policies as well. You've got positive policies in terms of potential tax cuts and deregulation. On the other side, you've got tariffs and immigration. So just starting with what was talked about on the campaign trail, I think is a great example of the volatility that could come for the next 4 years.
Matthew Palazzolo, Bernstein's Private Wealth Management Senior Investment Strategist. Thanks so much.
Pleasure.
Let's kick it over for our chart of the day. Yahoo Finance's Madison Mills is taking a look at the Thanksgiving trade. Maddie, what is the Thanksgiving trade?
I've got a little bit of a tasty Thanksgiving trade idea for folks listening this morning. This is from the Stock Traders Almanac. It's Technicals Fund, and they took a look at the S&P 500's performance since 1950 from the Tuesday before Thanksgiving Day, so today, all the way through to the first trading day of the new year. Stocks go up, specifically the S&P goes up 80% of the time within that range. It goes up by an average of 2.6%. Even better if you've put your money in the Russell 2000, that's going to be an average jump of 3.3% in that same time period. Now, Jeff Hirsch from Stock Traders Almanac was asked about whether or not the year-to-date performance and rally we've already seen could potentially throw off this dynamic a little bit. He said not to worry. We're still expecting to see that lift. Skeptics pointing out the fact that we've seen a fade in some of the names that we've relied on. Your old reliable here, NVIDIA, is down over the past 5 days. So if that trend did continue, you would need to see a bit more of a broadening out to have this play out heading into year end. Having said that, though, today we are seeing a little bit of a change in the sector performance off the heels of that tariff announcement from President-elect Donald Trump on Truth Social last night. We're seeing a lift in some of these chips names like NVIDIA off of that news, and also energy, while those automakers are fading back to the downside. So potentially that election dynamic and the potential policy positions coming out over the next couple of weeks could play into this dynamic. But again, consensus seems to be we've had plenty of elections since 1950, and we've still seen this average return of 2.6% in the S&P from that Tuesday before Thanksgiving to the second day of the new year, guys.
Maddie, thanks so much. Some interesting stats there. We're going to be watching it as we're thinking about what's on the table for Thanksgiving. Coming up, we're assessing the economic outlook for Trump's second term when Morning Brief returns.
President-elect Trump is promising more tariffs. In a post on Truth Social, Trump laid out plans to impose sweeping new tariffs on Mexico, Canada, and China as soon as he takes office, following up on one of his core campaign promises. Joining us now, we want to bring in Joseph Lavorgna. He's the chief economist at SMBC Nikko Securities America and former chief economist at the National Economic Council under President Trump. It's great to have you here, Joe. Thank you so much for taking the time. I guess Wall Street is trying to wrap their heads around what exactly this means in terms of the implications economically, the implications here for the markets. I'm curious just to get your assessment of what this would mean.
The tariffs, I've argued, and this is consistent with President-elect Trump's economic agenda, which is an integrated approach whereby you have tariffs that occur alongside low corporate tax rates, low regulations, a cutback in government spending, and abundant energy output. And essentially all those things work together to slow the offshoring, to get more onshoring, more reindustrialization in the U.S. economy, and essentially build a much stronger base. And tariffs are a key tool in using that agenda.
Joe, do you see it as more of a threat, or maybe not threat, a negotiating tactic, or do you see this potentially really reshaping global trade as we know it?
As Secretary Designate Besson has said, it's escalate to de-escalate. So there's certainly a transactional component to it, no question. But it will depend in part on a case-by-case basis. And as President Trump highlighted last night, there are certain countries that certainly are going to be caught more in the crosshairs, where there certainly needs to be more reciprocal trade and more even fair trade. And certainly China fits that mold. So it will depend. I think the markets generally have things right. They're very excited about President Trump's policies. And we saw in the first Trump term that inflation was actually very low. And what's amazing, if we actually look at import prices from China, they fell. They fell from when President Trump was in office in January 17, really through the pandemic. It wasn't until the economy started really accelerating in the back half of 2020 that import prices from China went up. So the U.S. didn't even bear the cost of those tariffs. It was predominantly China.
And so which industries do you anticipate might need to be making the most preemptive or proactive, taking those measures in even not knowing how this is going to kind of play out in the negotiation process once we finally do get there?
I can't speak to what industries, the overall benefit will be to the U.S. economy in totality, to try to really engineer much stronger manufacturing output to get worker wages higher. Certain sectors will be impacted more than others. Certainly the energy sector is very important in getting President Trump's agenda through in terms of keeping inflation low. And energy is such an important cost in the production process, in the industrial process. They need to have those energy costs low. And certainly you're seeing the energy sector respond positively. But beyond that, it's too soon to say who benefits, who doesn't. We'll see how the tariffs come in. But again, it's a key tool in getting the next administration's agenda done.
Joe, how should investors be thinking about the inflationary risk? We hear arguments from both sides. Some analysts are coming out, and economists are coming out saying that it's going to be almost a reflation trade sort of scenario. You have others, on the other hand, saying it's actually not going to have that substantial of an impact. What do you think?
Yeah, well, again, if you use the first example where there was over $300 billion in tariffs applied to China, almost $400 billion, import prices in China came down. China absorbed pretty much the entire effect. But the other point, as I mentioned with respect to energy is about 13% of the economy. The total share of imports is about 11%. So if energy costs move lower, that would offset any rise in tariffs, assuming there even was import prices coming from tariffs. That energy reduction could offset all, if not more, of any of that increase. So again, it has to be. I don't like when people just look at the tariffs in isolation. It's part of a total comprehensive process where everything is integrated, where companies want to come to the U.S. because it's low corporate tax rates, low regulation, cheap energy, things that are just favorable to producing. And I think that's the point. And tariffs are the key tool to getting our trading partners to the table, and also incentivizing companies from not leaving, and of course foreign producers who would be tariffed effectively to come to the U.S.
Do you think that there's an impact to the Fed's policy decision if we do see tariffs come forward in the way that they are being proposed, both on Truth Social and via the campaign trail?
That is my biggest risk. I wrote a piece last week on Trumponomics about how I thought the Fed is really the big risk, because the way they unfortunately model the inflation process, it's generally wage pull or demand push, meaning if the economy is growing too fast, the labor market's too tight, the Fed treats that as inflationary, which I fundamentally don't agree with. The Phillips curve, as it's known, is an unstable relationship. And therefore, I'm fearful that the Fed may look at these tariffs potentially as being inflationary when they're not. A tariff is a tax that is a price level adjustment. It's not inflation. What will happen is if energy prices come down, then the inflation rate will drop because there are second and third order effects that occur from lower energy costs. But my fear is the Fed will misdiagnose what the tariffs are designed to do and not raise rates next year, but potentially stop cutting rates when in reality they should.
They should stop cutting rates now?
I don't think the Fed should stop cutting rates now. I'm saying next year, when the Trump economic agenda is passed, I'm worried the Fed may stop, take a wait-and-see attitude, fearful of inflation that doesn't manifest itself.
Okay, that makes a lot of sense. Thanks so much for clarifying that, Joe. Joe, real quick, I'm curious just to get your assessment of the labor market right now. We've had some signs of weakening here, but overall, when you take a look at the numbers, it still looks pretty steady. It still looks relatively resilient. Are you at all worried about some of the weakness that we are starting to see there within jobs?
That's why, yes, and that's why I believe the Fed should cut rates generally. I don't know if they're going to cut in December. Maybe it makes sense to take a pause, but interest rates certainly need to come down. In fact, if you look at the payroll data, take the 3-month moving average, because we have a lot of monthly volatility. But if you take the 3-month moving average of private jobs going into September before the weather impacted the data in October, we're only 109,000 private jobs. And then if you take away the healthcare sector, which is basically quasi-government, you're only looking at like 50,000 jobs basically on average per month the last 3 months. That's a pretty soft rate. So we've got a lot of downward momentum in the labor market, and that's something that if I'm at the Fed, I'd be mindful of and be a bit concerned about.
Joseph Lavorgna, who's joining us here today, the SMBC Nikko Securities America Chief Economist. Thanks so much for taking the time.
Thank you, everybody.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. You're watching The Morning Brief, brought to you by Invesco. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, Intel has secured nearly $7.9 billion in federal grants from the Biden administration's CHIPS Act. The funding, designed to encourage chip manufacturing in the U.S., will support multiple projects across Arizona, New Mexico, Ohio, and Oregon. You're taking a look at shares of Intel. They still are slipping. There is some overhang from a story that we'll get to in just a hot second here. But the grant is really looking at directly supporting their plans to expand production, including investments of $90 billion by 2030 as well here. And they got to hit some key milestones, like me hitting that time marker.
There we go. Let's take a look at Qualcomm. Its interest in acquiring Intel has reportedly cooled. That's according to a report out from Bloomberg. Now, people familiar with the matter saying that the complexities of a merger made the deal less attractive to Qualcomm. Now, they're talking about an entire takeover of Intel. This report also went on to say that it is possible going forward that Qualcomm does look at pieces of Intel instead, or rekindles its interest later on, sometime next year or going forward. But as of right now, at least according to the Bloomberg report, Qualcomm no longer interested. We're seeing Qualcomm shares rise today.
All right, finally here, we've got Tesla on deck. Tesla's EVs would be excluded from a rebate deal under a proposal by California Governor Gavin Newsom. Now, Newsom's saying that if President-elect Trump eliminates the EV tax credit, he'll offer rebates to EV buyers via a state program. Shares of Tesla, they're higher right now by about 0.4%. We'll round that off too. Of course, this is as California has been one of the more friendly states towards full self-driving and autonomous taxis, and is one of the two states that Elon Musk talked about on the call with regard to that.
All right, that does it for Morning Brief. Coming up next, it's Catalyst. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, Trump's tariff pledge sending ripples across global markets, how the news could impact your investments.
Plus, we hone in on big tech and antitrust expectations under a Trump presidency with VC alum J.D. Vance entering the White House.
And the Bitcoin rally stalling out after nearing the $100,000 mark. We're going to break down the expectations for digital currencies in the new administration. We've got some breaking economic data crossing the wire here. Consumer confidence data for November coming in at 111.7, very shy of the estimate, which was 111.8 here. Taking a look at the prior number, that was 108.7. So hopping up a bit above that, though, that number actually was revised to the upside at 109.6. So only hopping up a little over 2 points here in this month's consumer confidence data. That moved to the upside. Interesting to see whether or not that is an indication of consumer confidence following the heels of the election. We certainly saw that in the Michigan consumer sentiment numbers last week. And it was interesting hearing Rick Newman talk about how when you looked under the hood at that data, you saw a complete flip of Democrats flipping to the downside, Republicans flipping to the upside in terms of positive feelings about the path forward for the economy. Interesting to see later on as we look under the hood of these numbers whether or not the similar story is true for consumer confidence data.
Maddie, we also have new home sales out for the month of October here this morning, falling to 610,000. That was below the street's expectations here. The forecast was in the range of 688,000 to 751,000 there. New home sales falling 128,000 in the month of October. That was down from the prior month. Previous 3 months for new home sales data, that was also revised down by about 38,000. When you take a look at the median new home price, that rose, maybe to no surprise, up nearly 4%. It was a move higher of 3.8% on a year-over-year basis. Right around, or just below, I should say, 438,000. The average selling price was $545,800. New home sales on pace for 680,000 this year. That was compared to a 2023 total of 666,000. So again, at least for the month of October, we're seeing a miss here. The fact that it fell to 610,000 versus the estimate of 725,000. Let's talk about that and more next. Seeing the real estate sector as a key area of opportunity for investors next year. We want to bring in Brad Newman. He's the director of market strategy at Alger. And Brad, talk to us just about, want to get your reaction to this number and why you see this setup as attractive for housing heading into the new year.
Well, the new home sales data that you cited looks soft. We think that structurally it's a good market and that America's short maybe 2 million homes. So we need to construct new homes to house people. And on the remodeling side, existing home sales is pretty weak. It's well below normal levels. So, Alger, we're growth investors. We're looking for companies that are gaining market share. And if we can find them in industries that are cyclically down on their luck and could recover, then we can get a really quality growth stock at a cheaper price, which is nice. And so, there's several stocks that fit the bill there. For example, Trex, which makes composite decking, which is lower total cost of ownership over the long term than wood and more environmentally friendly. Trex is the leader in that market. They've got about 55% market share, and each year that composite decking takes 100 to 200 basis points a share. So we see it as a great growth company that is in a cyclically challenged industry that will ultimately come back.
What's the model or the rubric that you're utilizing to suss out the winners within sort of flailing sectors? Because that strikes me as the thing that's really hard and why, you guys get paid the big bucks.
Yeah, well, we've been doing it for 60 years, so we've always been growth investors. We look for companies that have a strong value proposition. So I just mentioned, for example, with Trex, that their product really resonates with buyers because it has a low cost of ownership. So a company has to have a good value proposition for its product or service. It has to be gaining share, has to have a strong management team, competitive advantage. And if it has all those things, then the fundamentals will take care of itself and we think provide strong returns for investors.
But as you take a step back and looking just beyond housing and at the market overall, lots of questions just about valuation, concern, I should say, about valuation, some concentration, obviously, within the market. I'm curious how you see a Trump 2.0 administration affecting those trades down the line.
So There is valuations are high, and sentiment is pretty lofty. If you look at consumer confidence in stocks, it's last month it was the highest it's ever been reported in terms of people looking for gains in stocks over the next 12 months. But that said, we don't think investing in policy or investing for short term is how we look at things. We look at investing in companies that are going to gain, like I said, market share over the long term. And so, if you went back to Trump 1.0 and you want to invest in policies, you'd probably be in value-oriented, domestically focused companies. And those companies did do well from kind of the election in 2016 through March 2017, and the value rally fizzled out. And if you looked at the 4-year period from Trump 1.0 election to the following election, value stocks, Russell 3000 value was up about 16%, and the Russell 3000 growth more than doubled. So we think innovation won out in Trump 1.0, and we think the same thing will happen in Trump 2.0.
I wonder, though, if we could start to get a little bit of a feedback loop. There's this idea that the market is going to be a check on Trump, but when he has an announcement like the tariffs announcement overnight here, and the market continues to be moving to the upside today, then is he even more emboldened to issue more tariffs, and then it just kind of continues from there. What does the lack of a market reaction tell you about what the market's feedback loop could look like under Trump 2.0?
I agree with you. The market will probably serve as somewhat of a governor here. So what the tariffs that he were alluding to were actually maybe even below market expectations. 10% China is kind of low. I mean, yes, if you put all those tariffs into effect, you'd have 50 to 75 basis points of inflation. And if they all went into effect, that would be worse for interest rates than I think some people are expecting. But not all of those should go into effect, and I think the market was braced for kind of a scarier announcement. So I think that's one of the reasons why the market took it in stride.
Right, that's a really good point. Thank you so much, Brad Newman. Really appreciate you joining us in studio. Thank you so much. Let's take a look now at some market headlines to start the hour here, sponsored by Hasty Trade. We're going to take a look first up at the major averages. If we can pull that up on my screen here so that I can take a look at what we're seeing across the S&P, the NASDAQ, and the Dow. The S&P and the NASDAQ here still moving to the upside. You've got the S&P up about 0.3%, the NASDAQ up about 0.5%. The Dow still moving to the downside, though. Let's now flip it over to the Treasury space so I can take a look there. We are seeing yields moving up just a bit today. You've got the 10-year hitting just at 4.3, up about 4 basis points this morning. And finally, let's take a look at Bitcoin as that's continued its fade to the downside. You're looking at 93,000. It's down just about 2% today, making that stride to that $100,000 mark even further away this morning. Now, coming up, we're taking a look at today's trending tickers. We're going to give you the news behind those moves next, right here on Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. It's all at Yahoo Finance's trending tickers page. First up, Walmart rolling back some of its diversity, equity, and inclusion programs after facing pressure from a conservative activist. The retailer saying it will stop using the term DEI in official communications and stop racial equity training for staff. Walmart will also stop allowing third-party sellers to offer some LGBTQ-themed items on its website. We want to bring in Simone Foxman, Bloomberg News equality reporter, joining us now. Simone, it's great to get you on because of your extensive coverage on this topic. I'm curious how investors should be looking at an announcement like this. Do we typically see any sort of correlation between these types of announcements and the performance that we then see in their stocks?
Well, there's been a wave of companies who've rolled back or curtailed in some way their DEI initiatives, especially since June. And frankly, we haven't seen an enormous reaction in either direction after these companies make these announcements. What we have seen, of course, is investors responding to more botched treatment of whether it's the Budweiser blow up after the company used a transgender influencer to promote its product, and then responded poorly as it was criticized for that. Target carrying certain LGBTQ items in its stores, not necessarily handling that so deftly. So there's clearly from the corporate level a concern about a boycott or some negative amount of publicity, and that has impacted share price. But what hasn't really impacted share price is rolling back DEI initiatives, and maybe that is why we've seen now over 10 companies do so in just the last couple of months.
And Simone, what do you make of the influence of influencers online? One in particular, this conservative influencer, Robbie Starbuck, he's kind of claiming responsibility for this Walmart news. What can you tell us about his impact?
Yeah, so he just has a big social media following, about 700,000 people, and he's become extraordinarily influential. He'll go contact the company and say, I'm going to expose you if you don't roll back this program or get rid of DEI, et cetera. And, frankly, his word has been successful, especially in the likes of Tractor Supply. He went on a sort of campaign against them. So that's what, these companies are looking at. And in some cases, they've in fact shared board members. So these folks know the impact of his statements online. He's not the first, though. And frankly, there have been maybe more impactful, some legal challenges to various corporate diversity initiatives by the likes of Edward Bloom, by Stephen Miller, who's complained especially with certain regulatory authorities. And that's really had companies slowly looking at their diversity programs, trying to sitting with lawyers saying, are these legal? Are these going to, cause us problems? And so even more than the ones who've made these public announcements, and Walmart, I should add, said it was looking into its DEI programs even before this all happened. We've seen, at the margins, behind the scenes, companies, really reconsidering, are these DEI programs something that we should be doing?
And Simone, I wonder, you started the conversation off by talking about how we haven't necessarily seen a shareholder reaction, but can you talk to us more broadly about what your reporting tells you about any business implications for the rollback of these programs that investors should maybe keep in mind as they're sussing out Walmart and some of these other companies moving forward here?
I think the real question as we move forward is, do these announcements, does the rolling back, the curtailing of these policies change the way that these companies are able to retain talent? You look at Gen Z, they are a much more open group of people to LGBTQ people, they're a much more diverse group of people, frankly. And I think the question as we go forward, and certainly the executives who embraced some of these DEI initiatives and say they're going to stand up for them, have said, look, we care about retention. If we lose employees, that's an incredibly expensive thing to have happen. And so there has been a limited amount of research on this, not exactly definitive, DEI advocates will tell you, all the research says, DEI programs are great. There's a little bit of dispute about that. But, I think the ultimate bigger question is, what do companies need to do and need to say to their employees to make sure that they are happy? Are certain initiatives, whether it's mentoring programs, internships, employee resource groups, anti-bias training, how much do these cause a happy environment that employees simply want to stay? This is a question we just simply haven't answered yet, and likely it's going to take us several years to get to the bottom of how much some of the programs that went into effect after the murder of George Floyd really produced positive or perhaps negative environment for employees.
Simone, amazing overview. Thank you for bringing us your reporting on that. We really appreciate it.
Thank you.
Another trending ticker we're watching today, Amgen, the company's monthly weight loss drug showing promise in clinical trials. Yahoo Finance's Anjali Kemlani joining us now with a closer look at the data. Anj, what's interesting is that this recent study, I believe, showed the 20% of body weight could be lost on this drug, but then we saw negative reaction in the share price. Yeah. Was it too low?
It was not as high as they wanted. So the bull case for Amgen's drug has been that in addition to being a once monthly weight loss drug, it had stronger efficacy, meaning a stronger weight loss profile than what's currently on the market. We know Eli Lilly has the highest with about 25%, and then Novo Nordisk has about 15% for weight loss specifically. I want to point that out, that this is in the weight loss market, not the type 2 diabetes market. Amgen did also test this in diabetic patients who are obese, and it had a slightly lower profile there, 17% weight loss. And so this is all up to 52 weeks. Now, what Amgen is proposing here in these phase 2 trial data is that they see this drug as potentially weaning off of the once weekly cycle and offering patients an opportunity to move away from frequency. So they've also tested multiple doses, so 3 different doses. In addition, looking at once a month, twice a month, and even once a quarter. And that could really be the potential game changer. But it seems like the street is not pleased with this sort of mid-profile weight loss. And then there's also questions about what the path forward is. What path will Amgen choose that could really make it a key differentiator in the market? We've got Jefferies analyst Michael Yee kind of pointing to that in his comments, saying specifically that the discontinuation and safety profile, which is, fewer people got off the drug than we've seen in the past due to nausea and vomiting. And the safety data are okay, but a little bit higher on most areas, and a little bit higher on most areas than expected. But the bottom line is that the overall results are, quote, in line for moving to phase 3. So it's not the bull case that they've been looking for. So it seems like that's really the key here right now, is Amgen hasn't convinced Wall Street that it's going to be able to competitively play against the market dominators, Lilly and Novo.
And while we have you, there's also news out this morning. Biden administration's proposing Medicare and Medicaid coverage of some of these weight loss drugs. This is pretty substantial, just potentially given access here for millions of Americans who right now do not have coverage for these drugs.
That's right. Medicare has been really restricted from being able to cover it because of a statute that did not allow obesity medication coverage. And this goes back many years when there were all those, miracle weight loss options that were pitched out. And so CMS is now proposing to reinterpret that statute and be able to cover it both by Medicare Part D as well as Medicaid programs. Now, it's interesting to look at sort of where it is covered right now. So if you look at Medicare coverage in particular, it does already cover the type 2 diabetes format. So Ozempic and Mounjaro for Novo and Lilly respectively, as well as Rybelsus. Spending on it has already been a little bit over the top. We've been tracking data from about 2019 onwards, and spending in 2022 for Ozempic alone was more than $4 billion. And so that just tells you sort of what Medicare is up against. Medicaid also surprisingly has pretty decent coverage, or at least access to. Reuters did a recent article about what the potential access is, and it's more through Medicaid than through commercial insurers, which some of these companies are saying about 90% of commercial insurers do cover the drug. So it is going to increase spending. That's already been seen. The number of prescriptions has already been increasing. And so if it does come to Medicaid and it does come to Medicare, we're going to see that really open the doors. Now, this comes at a time where we know the Biden administration as well as Congress have been asking for these drug companies to reduce the pricing of these drugs, simultaneously talking about opening the door to access. So we'll see how that balances out.
You certainly will. All right, Anj, great stuff. Thanks so much. We also want to turn to Bitcoin. Right now, it's further retreating from that $100,000 level. The cryptocurrency's 4-day slide is the longest losing streak that we've seen since Trump's election win. Joining us now, we want to bring in Jason Les. He's the CEO of Riot Platforms, one of the largest publicly traded Bitcoin mining companies here in North America. Jason, it's great to have you. We just had the price of Bitcoin up on the screen. We've seen a bit of a slide here, a 4-day slide, but still pretty impressive, the climb that we've seen. It's still above 92,000. We know President-elect Trump has made a number of comments just about the fact that he is very bullish on Bitcoin mining, specifically here in the U.S. under Trump 2.0 administration. I'm curious how you're thinking about it, maybe the strategy, how that shifted following Trump's election win.
Sure, and thank you for having me. It's been quite a momentous movement in the Bitcoin and broader cryptocurrency market since the presidential election. You really have to look backwards to understand why. There was a whole of government attack on this industry for the past 4 years, and that suppressed a lot of investment and took a lot of capital out of the space, sidelined a lot of capital while the rest of us have been trying to build this industry. And by simply being friendly and not adversarial, the new Trump administration has lifted a massive regulatory burden that was carried over this whole space. So I think that's why you're seeing a lot of excitement and movement in the price immediately following that election. I know there's been a number of engagements and projects that President-elect Trump have talked about relative to Bitcoin and cryptocurrency. And as industry leaders, we are very excited to engage with the new administration on these projects. But I would say by simply not being adversarial, even being just neutral, it is a 180-degree environment from what we have dealt with for the past 4 years.
How do you anticipate it impacting your business specifically? Because I know over the past year to date, for example, if I look at your stock, it's down a little over 24%. Do you expect to see a read-through?
Yeah, I think that with the new administration in the White House, with the changes that we've seen in Congress, we have opened the way for new regulatory clarity to come through. There's been a number of bills that have not been able to be passed because opponents to the space, both in Congress and in the White House, did not allow them to move forward. A lot of investors are sidelined because of regulatory clarity. I also think the new administration's view on energy and energy policy is very bullish for not only Bitcoin miners, but HPC AI data center developers as well, and all sorts of technology that needs more power. So I'm very excited about the new era that we're going into this industry. While a lot of the Bitcoin stocks have suffered year to date, I think you've seen tremendous rise, Riot specifically up about 40% over the past 3 months. A lot of that kicked in following the election.
We also have heard talk about the fact that President-elect Trump could appoint a crypto czar. Is that just another catalyst you're seeing for the industry?
I think having expertise inside the White House advising the president and the rest of the administration on crypto Bitcoin policy, I think that's very important. Industry perspective, industry insights always helps lawmakers make good decisions. And what I'm very grateful for is the lawmakers that we have built relationships with and educated and worked with over the past few years. And bringing all of these parties together with a role like that, I think can be very beneficial for making the United States a leader in Bitcoin.
We've also seen a slew of companies benefiting from the broader Bitcoin rally. One of them, of course, being MicroStrategy, continuing to buy Bitcoin at its highs, even issuing debt to be able to purchase more Bitcoin, which then pushes the stock higher. Would you consider a similar process over at Riot?
We're following these developments really closely. We're open to all options to create shareholder value. I think what MicroStrategy is identified and taking advantage of right now is the fact that there is a lot of fixed income capital that is looking for exposure to Bitcoin. And in many of their cases, convertible bonds are the only way to get exposure to that. So that's why you're seeing companies like MicroStrategy get very attractive terms, zero coupon debt, long dated debt, and with the use of proceeds simply to buy Bitcoin. So there's certainly interest in this. It's certainly something that we're following closely.
Does it? That sounds a little bubbly to me, Jason.
Well, you have to remember, a lot of these fixed income investors, they do not have any other way to get exposure to Bitcoin. They cannot buy Bitcoin. They cannot invest in Bitcoin equities. But what they can invest in is fixed income instruments, securities like convertible notes. And there's still a conversion premium, so those investors are getting a return. And while it's unsecured debt, it is effectively built on top of the foundation of Bitcoin that MicroStrategy has built. So I don't know if I would use the word bubbly, but what I would say is there is a momentous amount of demand right now.
All right, we will see. Jason Les, thank you so much, Riot's CEO, for joining us this morning.
Thank you.
Coming up, what does a changing of the guard in Washington mean for the Biden administration's antitrust crackdown, specifically for big tech? We're going to discuss that next, right here on Catalyst.
Get to the latest on big tech's regulatory battles. Google potentially has a lot to lose if the Justice Department successfully breaks up its empire. So do other tech companies in the search ecosystem. Here to break it all down and what is exactly at stake, we want to bring Yahoo Finance's legal reporter Alexis Keenan. Alexis, what do we need to know?
Exactly. Really tough to do. But my colleague Dan Howley, our tech reporter here at Yahoo Finance, the two of us have been trying to kind of put into some buckets the dollars that are at risk in this search case that is pending a judge's decision on remedies for just Google's search case. And meanwhile, you had closing arguments yesterday in the Google ad tech case in a district court, a federal court in Virginia. So if we focus, though, just on search, we find that these DOJ fixes kind of span across not just Google's search business, but its other businesses as well, and also into the broader tech world. But first, if we focus just on Google search, that business unit, really, it's woven into Google's ecosystem of companies. So the DOJ wants to end contracts that secure search as a default across a lot of devices. Big one, Apple, of course, and Apple Safari. But if those search defaults went away, a search alone in 2023 accounted for $175 billion of Google's $307 billion in annual revenue. That is 67% of the company's annual revenue for 2023. Also, the DOJ asking to divest Chrome, to divest Android, both of those arguably fuel search as well. So you kind of have to start imagining these different buckets as crossing over, where revenue, of course, would be impacted across beyond search. Also, those two, Chrome coming pre-installed on Android devices, as well as set as default on Android devices. And then on top of it, you have Chrome Enterprise Services. That's its own business unit. That falls under Google's cloud business revenue. So completely separate from that search bucket. Go down to another layer. The DOJ wants Google search to stop favoring YouTube. YouTube ads, it's its own business unit, $31 billion in 2023, 10% of Google's annual revenue. Then you have subscriptions. That includes YouTube subscriptions, another $31.5 billion. So you kind of get the idea here. So really hard to unpack specific dollar figures. And then if we step into kind of the outside world of Google, you have the Brave browser, you have Microsoft's Bing browser. Arguably, those would be impacted too if there was a forced sale of Google Chrome. Those companies, the head of ads for Brave tells me, well, if Google is forced to sell Chrome and also forced to sell its API for so that search can be across other browsers, you have to wonder if that would put Brave and Bing out of business. And then, of course, one we've talked about that's huge is the $20 billion that Apple is receiving for that default placement.
You never want the impact to start with the letter B, that's for sure.
Yeah, big ones, big Bs.
Thank you so much. Really appreciate you bringing us your reporting and breaking all those numbers down for us. We appreciate it as always. Staying with antitrust oversight, big tech hoping to catch a bid from the incoming administration. But since his election win, Donald Trump has tapped a string of conservative figures who are critical of big tech. Notably, Trump's vice president, former Silicon Valley investor J.D. Vance, has long championed a stricter crackdown on big tech. Here with more, we're joined by Bradley Tusk, Tusk Ventures Partners founder and CEO. Always great to have you in studio. Thank you for coming in. Sure. So what is your anticipation? And I know kind of more broadly, you did not necessarily want this election result.
No, wasn't my choice. That's okay.
So how are you feeling just about the path forward here, specifically for your investments?
All right, so for VC, I think actually there's some optimism, right? Because the last 4 years or so, attention, the stock market, as you guys know, because you do this all day, has been really good, but the VC market's been terrible since there's been no liquidity, right? So very few tech IPOs, very little M&A, and I think the combination of the interest rates cuts that we've seen from the Fed, combined with some new regulators coming in, especially at the FTC, I think has created optimism among venture capitalists, which I think will lead to more activity in general. So that's a good thing. The vast majority of actual tech regulation doesn't really happen at the federal level. Like when we think about politics, the White House or the Capitol, like our mental images of something in DC, most of it really is state and local, but there are a couple of industries. So crypto, as we've seen, and Bitcoin, last I checked, was like at 99, maybe it's even more now, I don't know, is going crazy, and they will certainly have more favorable regulatory treatment. I think we'll have an FTC that may not change to the segment you guys just did, their posture in terms of big tech regulation, but for the venture world, I think what we're worried about more is just this chilling effect where there's almost no M&A activity across the board, and I think that kind of the brakes being taken off there will be really helpful. And then other than that, we will just see a lot of the Trump administration is still business as usual in the sense of the Defense Department's still going to buy tech. Right, the HHS is still going to regulate telemedicine. Yeah, I mean, you have some crazy personalities in there now, but like when you look at Kennedy or Hegseth or any of these people, none of them seem to have any sort of pre-existing views about tech specifically that are worrisome.
The replacement, I think, of Lina Khan, obviously, is something that's very much a focal point within the industry and beyond, obviously, beyond tech. I'm curious how you see that replacement road shaping up under the Trump administration. Lots of reports just about who could be considered.
Yeah, and it's really interesting, right? Because there is a place where sort of the left and the right kind of the circle gets squared, right? And J.D. Vance is actually supportive of, really regulating big tech. And I would say I understand his perspective because as a venture capitalist, which he was too, no one ever comes and pitches me and says, hey, I'm going to compete with Google. I'm going to compete with Meta, Apple, right? And the problem is, yes, these are all incredible companies. They have their harm that they do. They have their good that they do. But their businesses, which means, guess what? Over time, every business stagnates. If that were not the case, Standard Oil and Union Carbide and General Electric would be the biggest company still today, right? So at some point, they're going to go the way that every company goes, which is the founder, whoever it is, eventually leaves and the culture changes and they become more bureaucratic and more political and everything else. And to me, the real risk to the American economy is if early stage investors like me are not able to put capital into people who want to take on these companies, then the new businesses never get seeded. And of course, most of them fail. That's how early stage venture works. But at one point, Google and Amazon and Meta were also early stage tech companies, and they succeeded. And if you don't have companies kind of waiting in the wings to fill the void when the big players today ultimately grow stagnant, then all of a sudden that's a huge hole in the marketplace that A, makes us a lot more vulnerable to companies from other countries, and B, it's just less innovation means a worse economy. And so I think that if you really do care about innovation and economic competitiveness for decades to come, the right policy for the FTC would be continue the big tech prosecution, the Googles, the Apples, the Metas, but make it a lot easier and stop sort of creating this chilling effect that kind of stops all M&A activity across the board, because you do need that in order for the venture ecosystem to work and for new company formation to happen.
So for early stage, what potential policy position from Trump are you looking at the most? It strikes me that immigration could be a potential.
Yeah, but so a little bit in terms of employees, but keep in mind, like my portfolio companies, when they're first starting out, have 5 to 20 employees. So I am for radically expanded immigration. I am for giving everyone with a good skill set an H-1 visa. Like, that's my view. With that said, my portfolio companies are not, I think, going to radically struggle to hire the talent that they need either way. I think depending on the type of early stage investor you are, so if you are investing in hardware, infrastructure, things like that, the tariffs could prove problematic, because if the raw materials that your startup needs to build whatever it is they're building have to be imported from China, or it sounds like today, Canada or Mexico, that may all of a sudden make it no longer economically feasible to do what you're trying to do. I tend to invest more on the software side, so there's a little bit less of reliance on things like, can we get cobalt or whatever it is? But I think people who do invest in deep tech probably have a little bit to worry about.
Bradley, we had a chance to ask Jason Furman yesterday specifically about AI regulation and his, I don't know much to say advice, but just his viewpoint in terms of what needs to happen. I want to play a quick soundbite and then get your reaction to his thoughts.
First of all, the goal of the regulation should be to get more AI. This is not something we should be afraid of. We should be afraid of not having enough of it to give us the innovation we need for education, for wages, for medical research, et cetera. We need to get rid of some of the obstacles that stand in the way of AI, things that, for example, make it harder to set up nuclear power plants that they'll need to create the type of clean energy to fuel their data centers.
So Bradley, similar along the lines of what you're just saying, I guess, how do you regulate AI without stifling that?
Yeah, and I think Jason's take is generally right. To a few things. Again, to that point earlier about how the federal government really isn't the main tech regulator, while in theory, Trump could try to regulate AI, and I saw something in Axios this morning about like an AI czar or something like that, it's going to happen at the state level. So I don't know if you guys remember the California bill from a few months ago that Gavin Newsom vetoed. Probably a couple of dozen states right now are creating their own regulatory framework for how to govern AI, how to do safety testing, everything else. And at the federal level, we still haven't regulated Internet 2.0 yet, right? We still don't have any sort of data privacy framework. We still have Section 230. So there'll be a lot of talk at the federal level because politicians live for getting attention, and they know that if they say the words AI, you guys will jump and then give them attention. But in terms of them actually passing meaningful regulation or legislation, I think the odds of that happening at the federal level are really low. It's going to happen at the state level, and where I think the open AIs of the world need to be a little careful is they killed the California bill because they felt that it was too onerous for them. But the problem is California could have at least been a template for the whole country, for all the different states. Now you're going to get 24 different frameworks, and trying to comply with that's going to be really hard.
Sorry, Bradley, just real quick. How much does that complicate then the picture, the scaling effect for some of these smaller companies? If you're having to abide by potentially 50 different rules, 50 different laws, I mean, how do you at some point that does stifle?
Yeah, it does. If you have to sort of have a different licensing regime in every single state and different testing requirements and everything else, that's going to make it a lot harder. And what you might see is some states say, you know what, the regulations, and I'm making this up, but in California or Texas, whatever it is, are too onerous. We won't do business there, right? And it's not just where your company's located, it's where customers are located. So yeah, I mean, we would be much better off with a rational federal AI policy that allowed both for AI to advance, but also recognize that there's the reason why we're all so excited about AI is there's amazing upside and incredible downside. And what you have to do is figure out, we don't want to limit the upside, but we want to protect people, right, from all the harms that can come from it. It's not like a bunch of smart people in Washington couldn't figure out the right plan, but we have such a dysfunctional, polarized government that actually getting that through is going to be incredibly hard, if not impossible, which is why you're going to see it default to the states, just like almost all social media regulation has defaulted to the states. And that becomes incredibly hard to comply with, and in a weird way, becomes a built-in monopoly for the bigger companies.
Really great point. Bradley, thank you so much as always.
Me.
Really appreciate you coming in always.
Great.
Thank you so much.
Sure.
Bradley Tusk, as a reminder, he is with Tusk Venture Partners as the founder and CEO. Coming up here, the dollar is gaining on those new tariff proposals from President-elect Donald Trump. We're going to dive into the moves in the currency market with an expert next, right here on Catalysts. The Mexican peso and the Canadian loonie weakening against the dollar today after President-elect Donald Trump laid out plans for 25% tariffs on all products from the U.S.'s neighboring countries. That came out in a post on Truth Social. For more on this, we've got Thierry Wiseman. He is an FX and rate strategist over at Macquarie Group. Thierry, thank you so much for being here this morning. I'm just wondering if you think that the FX market's reaction is sufficient here. Is there any underestimation going on in terms of trade war risks?
No, I don't think there's underestimation. If anything, the market is probably panicking a little bit too much around this announcement that President-elect Trump made last night. Although he threatened to slap tariffs on Canada and Mexico on day one, I suspect that that's not really his intention. This is ultimately a game of chicken. And what he's trying to do is bring Canada and Mexico to the table before day one to try to elicit some concessions from these two countries with regard to the U.S.'s priority demands. on border security, on immigration, on drugs coming through the border. I think by threatening, what he effectively gets is a willingness on the part of these countries to negotiate with the transistor team ahead of day one, so that when we get to day one, he can make a case that he's already starting to see some progress from these countries and their willingness to cooperate, and therefore won't need to put on those tariffs. So the threats are not intended to be ineffective; they're intended to be effective. But that doesn't mean that he's going to follow through if he gets those concessions or a path towards those concessions.
Terry, what does that tell us, though, just about the ongoing strength of the dollar? Certainly, we have seen this rally. The strong U.S. dollar seems to be a key theme here to Trump's incoming administration. I'm curious, do you almost view it as a defining aspect of the economic agenda? I guess, how should investors be thinking about that?
Well, there's certainly an aspect of Trump's economic agenda that I think is different now than it was in the first Trump administration, i.e. 2.0 is different than 1.0 with respect to the dollar. I think in Trump 1.0, there was definitely a view that the dollar should weaken. And that was intended to promote U.S. competitiveness vis-a-vis our trade partners and to promote U.S. job creation. But we have effectively a full employment economy these days. And I think that the reason that that Trump 2.0 has shifted on this basis and is now an advocate of a strong dollar is because I think they realize that the inflationary implications on tariffs, specifically on China, will work to the detriment of the U.S. consumer unless the dollar strengthens sufficiently to offset the inflationary implications for the U.S. consumer, and inflation as a result of a strong dollar is not going to be as strong. So, there is a shift. It is no longer an advocacy for a weak dollar. It seems to be more an advocacy for a strong dollar. Scott Bessent, the incoming Treasury Secretary, seems to have gotten on board on that view as well, if you read his recent interview. And on that basis, there is a reason to believe that the dollar will stay strong over and above the other things that are driving the dollar stronger, including more hawkish Federal Reserve policy. So we're of the view that even if the dollar does not strengthen from here, it's likely to just stay where it is and stay strong throughout the next few months.
All right, Terry Wesman, we wish we had more time. We'll have to have you back soon. Macquarie Group's FX and rates strategist. Thanks so much.
My pleasure.
Keep right here on Yahoo Finance. We have much more coming up. You're watching Catalyst.
One of Scott Bessent's key policy aims as the nominee for Treasury Secretary is to produce an additional 3 million barrels of oil a day. President-elect Donald Trump has also vowed to, quote, drill, baby, drill. Meantime, analysts expecting the U.S. to add about 250,000 barrels a day through the next year. That would be the slowest pace since 2020, according to Bloomberg. Here we've got David Callaway. He is the founder and editor-in-chief at Callaway Climate Insights to discuss. David, it's great to have you in studio. Thank you so much for making time for us this morning. Talk to me about what you're anticipating under the new administration and how you're thinking that these potential policies, including what we just mentioned from potential incoming Treasury Secretary Scott Bessent, could impact energy moving forward.
Well, Bessent's clearly was trying to sell himself to the job when he told Trump about his 3-3-3 or 3-3 strategy of 3% GDP, 3% deficit cut, 3 million barrels of oil. We're already at 3% GDP. I think we're at 2.8 or something like that. So that's low-hanging fruit, right? 3% deficit cut, we could talk all day about that one. But the 3 million barrels of oil, that's about a 20% increase in what we're doing. We do about 15 million barrels of oil a day in the U.S. already. That's huge. And while I'm no doubt that Trump wants to drill that much, the markets probably don't need that much. We know where oil prices are today. They're not that high. We're swimming in oil. We've got a whole bunch of renewable energy waiting to be plugged into the grid. So I'm not sure they're going to get that one. Remember, to drill oil and drill shale and tar sands oil, and you need the price to be at a certain level to make it economical. So the oil companies may not quite agree with this plan.
David, I guess to the degree, what do you fear just in terms of what those setbacks will be? Because also just with Lutnick, one of the recent op-eds that you wrote, just in terms of implementing strategy and what exactly happens, the policies under the Trump administration, very much speculative still at this point. But I guess what do investors need to be aware of that very much are some of those risks?
Well, I think investors need to look back to the first Trump administration for clues of what the second Trump administration is going to be. It's going to be chaos. It's going to be drama. It's going to be infighting. The new cabinet that's coming in might not necessarily be the cabinet that is there in 2 years, right? We know bringing in all these leaders, Lutnick and Bessent, remember when he brought in Wilbur Ross and Rex Tillerson from Exxon and Steve Mnuchin from Goldman Sachs? Only Mnuchin really lasted the entire term. So there'll be a lot of infighting. I think investors need to take it with a grain of salt. We saw it with the tariff comments yesterday on Mexico and Canada. Shook markets around the world. Even markets that he didn't mention reacted. He's just creating drama, and that's what he likes. He likes to operate within chaos. And so investors need to kind of be a little bit wary. You'll see it here at Yahoo Finance, because if you remember, he used to mention in particular stocks, and the stocks will go crazy, right? So it's going to be fun as a journalist to cover. I think we can expect a lot of infighting. Probably a lot of these policy goals will be reset over time, and Trump will claim that that was his plan all along.
But it's interesting because on the flip side, we've heard some investors and analysts telling us that we shouldn't even care about the personnel around him. We should care what he says. He has said he's going to do tariffs. He mentioned it last night. The market moved. He said, drill, baby, drill. Why should we doubt that if he is the one who is in that Oval Office chair?
Yeah, he can only do so much given the time he has during the day. And granted, he seems superhuman, tweeting all night long and stuff. But the characters around him do mean something. And they will be infighting, and they will fall in and out of favor with him. But they do mean something to the markets. And especially, you've seen the market react to Bessent and somewhat to Lutnick. They are strong Wall Street personalities with huge track records. So it's better to have them in the seat than some of the other cabinet picks that we saw. I think the markets will be okay. And particularly, I think the climate markets and the clean energy markets will do better than most people expect. I think Trump will find he needs that energy, if only to satisfy his AI goals, which are new over the last 24 hours.
Is it Bessent or is it Lutnick that is the pick to watch here for climate investors?
It's more Lutnick, right? Lutnick is going to be the tariff guy. Yeah. And that's big work for China, which imports a lot of our solar panels and solar panel chemicals, a lot of our minerals for our electric vehicles. So he's that character. He's also responsible for NOAA, the National Oceanic Administration, which is responsible for all the weather forecasting and climate forecasting and data. Trump hates that agency. He says it's the thing behind the hoax. So Lutnick's going to be in the hot seat from day one, and not particularly well liked because of the Treasury race and everything that he caused, all the controversy he caused in the race for that spot. So I'd be watching Lutnick first. Bessent, I think, is a capable hand that will probably do as good a job as Mnuchin did.
30 seconds. How do you expect the private sector to respond on clean energy?
I think the private sector is going to respond. Private sector will respond to prices and economic ideas. Clean energy is cheaper. It's scaling up at amazing levels, especially solar power. I think those opportunities are still going to be there.
David Callaway, great to have you. Thanks so much for coming on set with us.
Great to see you again.
Callaway Climate Insights founder and editor-in-chief. Thanks so much. We'll keep right here on Yahoo Finance. It does it for us on Catalyst. But coming up next is Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we'll dig into the latest action in the markets, and one portfolio manager going to give us some insight as to why he's moving out of tech and into financials. Plus, ahead of a big week of jobs data, we're digging into the gig economy, how many people are participating, and what kinds of jobs are popular today. Plus, ahead of Turkey Day, we're bringing you 3 money themes that you just gotta talk about with your family over the holidays. Don't worry, we'll keep it clean. And a bonus tease, ahead of Black Friday and Cyber Monday, people are asking, should you say yes and open a credit card from a retailer this holiday season? We consult an expert, all that and much more during today's show, action-packed as it may be. First, we gotta take a look at the market action. We're 90 minutes into the trading day right now. We're seeing some mixed major averages here. The Dow down by about 0.5%, S&P 500 and the NASDAQ, though, holding on to gains. All of this activity coming following Trump's proposed tariff plans. Joining me now, we've got Keith Buchanan, good friend of the show, Globalt Investments Senior Portfolio Manager. Great to have you back here with us, Keith. You say you're leaning out of tech and into financials. Tell us why.
Well, thanks again for having me, Brad. We've been looking at growth as a source of funds for some months now. As it grew as a much larger component of major indices, we saw sentiment reach to extremes in a way that we just haven't seen in the past from a valuation differential between growth and value. A lot of that was largely the AI trade, kind of tech-oriented. So we've been moving to a more balanced approach here over the last couple of months. Not necessarily, selling or going, short tech in any possible way, but we do look at the potential for our economy to continue to grow, even beyond, historical trends. Tends to benefit value stocks in a way that just weren't reflected in the valuations. And our opportunity, we felt like presented itself for us to become more balanced.
And so when you talk about looking at financials right now and really having a preference, do you have a preference for some of the biggest banks out there, or is it towards some of the regionals?
We absolutely have a preference towards some of the larger money center banks. We have positions in Bank of America, JP Morgan, Citigroup, just to name a few. As the yield curve continues to, I think after yesterday, we still say that the trend is for the yield curve to continue to steepen. If growth rates continue above trend 2 to 3%, inflation continues to come in to a soft landing scenario. All that benefits the financials in a way that we can see loan growth and profitability improve, as well as economic activity and transactions continue to accelerate. All that benefits the larger money center banks in a way. And the regionals, we don't necessarily want to shy away from those. Those stand to benefit as well, but in a more concentrated way. And I think that's a little more geographically opportunistic rather than just making a play on global, macroeconomic trends, as I mentioned, for money center banks. But we're very positive on that group. And we've also started to spread some of our exposure elsewhere in financials as well.
If we were to see loan growth to the level that hits your projections, what does that spell out to you about the state of the consumer?
That's really interesting. We're actually thinking about that very carefully right now. The consumer is well employed, no doubt. That started to soften on the margin as bringing up some concern, as we've seen credit card delinquencies start to tick higher, not necessarily causing a lot of trouble at the banks per se. But we are taking note of what that means for the consumer. We've seen with some of the earnings rhetoric around Walmart and Target, how those almost seem like they're moving in opposite directions from an inventory and demand standpoint, as well as the consumers that are coming into Walmart. They've talked about more affluent consumers coming through and making larger baskets. And that's not necessarily anything that aligns with a reacceleration of economic growth. And the reacceleration of economic growth historically doesn't happen without the consumer participating, if not leading that reacceleration. So we're really careful about what the consumer is showing in their activity, even if that differs from their sentiment.
As you mentioned Walmart, naturally, I'd love to get your reaction to what you think of the results that we've seen from retailers over this point of the earnings season.
Sure. We're really impressed with what Walmart has been able to accomplish coming into the pandemic, out of the pandemic, when there's more preference for goods over services. And as that's shifted to services away from goods, they've been able to continue to grow and evolve around the current economic winds in a way that many retailers, frankly, just haven't been able to get as good a control as Walmart has been. Target has its challenges from an inventory standpoint that we saw a couple of years ago, and they're starting to reemerge, perhaps, in our view at least. But the consumer is always different. Every environment, no two environments are the same. And we've seen Dick's Sporting Goods, for instance, that reported this morning, look totally different from a Burlington or a Kohl's or even a Best Buy, if you will. So the consumer is evolving. Sporting goods seem to always be in vogue. And apparel and footwear seem to be a little more challenging as far as how to position the shelves where consumers' tastes currently lie. And we've seen challenges around that. Walmart is in our opinion, a logistical stalwart that can move things around and have warehouse space in every nook and cranny of the U.S. economy. So it can be a little more aggressive as far as how it positions itself. And that's been paid dividends over the past couple of years.
Keith, just lastly, while we have you here, what is perhaps one major outlier as you're looking at it through your lens for 2025 that you think investors would be apt to consider how it might benefit their portfolio?
We've been looking a lot more, again, to the original point of where can we find opportunities for earnings growth is not captured in valuations. And where we're seeing a lot more of those opportunities align is in the quote unquote traditional more value spaces. And we've seen that performance start to pick up. But we also have an equity income strategy that's seeing value names that have a dividend income stream that's reliable and growing to also benefit as well. We see free cash flow as a factor that's really driving a lot of equity returns in a way that it hasn't in the past. And that can benefit a lot of companies that just don't get the valuation that they perhaps deserve over the past couple of years, given the macroeconomic environment.
Keith Buchanan, who is the Global Alt Investment Senior Portfolio Manager. Keith, good to see you. Thanks so much for taking some time here with us today.
Thank you, Brad.
Certainly. Now time for some of today's trending tickers. You can scan the QR code below on your screen to track the best and worst performing stocks of the session with Yahoo Finance's Trending Tickers page. Joining me now, we've got my morning brief co-anchor, Shauna Smith. She's back live in living color to break down some of these names. We didn't get to talk about Abercrombie & Fitch, you and I didn't. So let's discuss this. Here's the setup. They're falling right now. And as the retailers' sales, their growth there falling short of analysts' expectations. Now, the third quarter net sales essentially matched expectations, and comp sales missed the street's estimate. But look at this. Shares sliding, slipping, whatever you want to call it down by about 5% as of right now, Shauna.
Yeah, I guess when you put it in the context of the performance year to date, this is a stock that had been up more than 70% when we did get these results before the bell this morning. So I think putting it in context kind of puts this whole earnings results into a bit better perspective here for viewers, because it was still a strong quarter here for the company. When you take a look under the hood at some of these numbers that they did report, same-store sales for the quarter at Abercrombie's namesake brand, they were up 15%. Hollister gaining 14%. We talked a lot about sweaters, dresses, jeans, fleece, also driving some of the sales that we did see at the Abercrombie brand, but it simply just was not enough for investors. We talked about Wall Street really having very lofty expectations going into this earnings season. And remember, this also comes on the heels of 7 straight quarters of year-over-year revenue gains. So any sort of disappointment, we have certainly seen these stocks take a hit this earnings season. Abercrombie & Fitch is no different. I also want to point out we did get an executive change. A new CFO has been appointed at Abercrombie. Robert Ball is the next CEO. He's been at A&F for just about 22 years, so a veteran there. The former CFO will be sticking around. He will now become the chief operating officer. But again, Ball, who has been at Abercrombie & Fitch for more than 2 decades, he will take that new role. It's effective November. Will begin the role effective very soon. So again, that executive change, I'm sure, will be in focus here for investors as well.
Yeah, I never feel older than when I walk into an Abercrombie & Fitch here. Ultimately, still a lot of good inventory mix, but man, I'm like the oldest person when I walk in there sometimes.
Yeah, well, Actually, that's a little surprising that you say that, because I was going to say that actually does not surprise me, because when I think of Abercrombie, I still think of when at least I would shop at it, which was in high school, but it certainly is resonating with more and more millennials. I think that has been so critical here and a crucial part of their comeback story, and exactly what we have seen from Abercrombie and the outperformance here of the last several quarters is being able to resonate once again with the millennial generation. I guess just not with you yet.
All right, yeah. Well, no, it's just that I look the oldest when I go in there. Maybe I need more anti-aging cream. Anyway, stay tuned. Abercrombie & Fitch CEO Fran Horowitz is going to join Yahoo Finance's Market Domination, 3:30 p.m. Eastern Time today. You don't want to miss it. And we've got another one, a bonus one. Actually, we planned on this one. Let's talk about Rivian. That's next up here, winning a preliminary approval for a $6.6 billion federal loan that would support construction of an EV factory here. Shares rejoicing as investors looking at this as some good news. Shauna, up by about 2.5% the shares are.
Yeah, Tariffs was out with reaction to this, saying that they see it as incremental good news here for the company, incremental positive, to put it in their words, providing another avenue for capital alongside Volkswagen joint venture. But Rivian has a lot to prove when it comes to production and exactly some of their targets over the next several years. This is a move by the Biden administration to deploy this capital before we have the change with the incoming Trump administration in the new year. In terms of what this is going to do for Rivian specifically, it's a new plant where they plan to produce SUVs and hatchbacks. They're going to start producing cars in 2028, so just about 3 years from now. Eventually employ around 7,500 people, 2,000 during the construction process. Their CEO saying that this loan is going to help them create thousands of new American jobs and further strengthen U.S. leadership in EV manufacturing and technology. So again, we're seeing some excitement play out this morning, but I think overall the street very much more so looking for this is very much a show me story in terms of what those production numbers are going to look like, what demand is simply going to look like for the EV sector in the quarters to come.
Yeah, according to the company, Rivian is expected to create approximately 7,500 operations jobs through 2030 at the company's future manufacturing facility in Georgia, the Bulldog State there. This is in addition to the 2,000 expected full-time construction jobs, going to utilize some of the talent in that region to really fortify the EV ecosystem for them too. Shauna, thanks for sticking around.
Of course, thanks for having me.
Appreciate it. All right, guys, also, we're tracking the housing market right now. New home sales falling 17% in October, hitting the lowest level in nearly 2 years. Yahoo Finance's Danny Romero joins us now with more on what this means for the housing market. Hey, Danny.
Brad, affordability challenges hit the new home market in October. Fresh data from the government shows that new home sales fell 17% in October. Remember, mortgage rates were marching higher during this month. They were hovering around 6.5%. So that really dampened the mood for a lot of potential buyers to look into the new home market. And we can't forget that also 2 hurricanes that ripped through the southeast really impacted new home sales on that front. Now, home prices haven't cooled off. The median sales price increased to around $437,000 in October. That is the highest in 14 months. Bottom line, builders will continue to sweeten the deal for more buyers to get back into the market, especially as we've seen mortgage rates currently, they are heading towards that 7%. So incentive levels will remain high. So it doesn't look too good, Brad, for the new home market right now.
Danny, while we have you, we have more housing data out today showing home prices rising, but at a slower pace, according to the S&P CoreLogic Case-Shiller Home Price Index for September. What did you find there?
The story here is that home price growth slowed in September. The S&P Case-Shiller National Home Price Index increased 3.9% from last September, and that is a smaller increase from the 4.2% annual gain seen in August. Remember, this is a lagging indicator because it takes about 2 months to collect all of this housing data. But looking ahead, economists expect that borrowing costs will remain elevated around that 7%, maintaining really those challenges, affordability challenges, conditions to really stay on the forefront here for a lot of buyers. So again, it seems like this data really is reflecting somewhat of the doom and gloom that we've kind of seen with mortgage rates as they've been marching a little higher in the most recent months, Brad.
Danny Romero, thanks so much. Appreciate it. Well, your thoughts might already have turned to turkey, but when we return from the Thanksgiving holiday, We'll get a barrage of jobs data that you'll need to pay attention to. We'll get JOLTS, job openings and labor turnover survey. And plus, we'll get ADP's private employment report, plus weekly jobless claims on Thursday, all culminating in the big jobs report on Friday. Ahead of that data, we're joined by David Tinsley, Bank of America Institute senior economist. David, great to have you here with us. All right, so just give us your broad take on the current state of the labor market and what we're anticipating to really get in terms of a continued trend or maybe a shift in these future reports.
Yeah, hi Brad, thanks for having me on. So, I mean, when we look at our Bank of America Institute data, I think I'll point to two pieces of data that suggest the labor market is kind of cooling, but it's not falling off a cliff. The first is we track in our small business data the payments small businesses make to hiring firms. In other words, they make those for job postings, etc. And those payments have tracked lower gradually, quarter on quarter over 2024, particularly services. But it's hardly a kind of runaway decline, if you like. And then the other piece of data I'd point to is on the wages side, where we also track in our consumer data the pay rise people get when they change jobs. And obviously back in the day, great resignation period, that was very high, 20% or so. And now it's just a shade below 10%. It's just a shade below where it was in 2019. So I think both those data points that are institute data points suggest the labour market is cooling, but nothing too dramatic in terms of our data.
How does that translate through to small business hiring decisions, especially as we think about the holiday seasonality that typically starts to show up in future reports?
Yeah, that's a good question. So basically, when we track these payments that small businesses make to hiring firms, we can look at the good side of the economy, where the retailers would be in particular. And you always see a rise around this time of the year, of course, because of seasonal hiring. But to us, it looks a little bit more muted than perhaps it did over the last few years. And so I think perhaps on the retail side, the seasonal hiring may be a little bit underwhelming. And also as conditions normalize and look a little bit more like they did before the pandemic, we might see a little bit more shedding in that seasonal downturn in the first few months of next year. So that's a little bit of a sort of softer patch of the data, I think.
And another element of the broader kind of economic and employment situation landscape is also the gig economy. What are you seeing in terms of the share of gig workers, the types of jobs that they're choosing, and how that all factors into the larger equation?
Yeah, you see, what we're seeing on gig side is, in a way, there are push and pull reasons to working the gig economy. And when we look at our data, roughly about 3.8% of our customers have some income from gig work. So it's been pretty stable over the last few years, actually. But there are some offsetting trends within the data. So social commerce and ride hailing, they have been rising. Deliveries, food deliveries I'm thinking of in particular, have been falling somewhat. And I guess that ties in with this idea that the consumer has wanted to get out the house, get out and about, actually eat out rather than order in. So there's a bit of that in the data too. We also like to look at social media influencers, gig income within the data. That's very low proportion of people getting any income from that. And the income of the average person in that area is a measure below. It's only about 20% or so of what a full-time job would look like.
You know, just lastly on that point, because that's particularly interesting, especially thinking about the correlation between where marketers and where advertisers want to partner with influencers in that social commerce sphere to ensure that there's a very kind of multi-channel, but also kind of multi-profile approach to getting their product through. As you see marketing budgets adjust potentially into next year, what does that translate through to some of the influencer economy that we've seen balloon over the past 7 years?
Well, in our data, we have seen the share of people, which is already, as I was saying, really small, getting income from that source. It has been declining a bit. I think for some of the reasons that you're discussing there, budgets being stretched, and also, it's a bit like a kind of sports team being an influencer. The people at the top make a lot of money and get a huge amount of clicks, viewers, etc. But the people further down, really, the income is not so great. And, the reach you'll get by using those, if you're on the media side, is probably relatively low, I guess.
Really interesting. Okay, we got to dive further into that one day. It's really fascinating. David Tinsley, who's the Bank of America Institute Senior Economist. Good to see you again. Thanks so much for taking the time. Coming up, everyone, 3 steps you can take today to lower your tax bill. That's next on Wealth. The steps you take today could save you big time once tax season rolls around. We've got 3 ways that you can maximize your bottom line and reduce your tax burden. Joining us now, we've got Bill Harris, who's the former CEO of Intuit and PayPal and founder of digital wealth advisor Evergreen Money. Great to have you here in studio with us.
Good to be here.
Okay, so let's talk about some of these tips and how people can take steps today in order to lessen their tax burden.
Sure. Well, let me just give you a setup first.
Sure.
If you are a high-income taxpayer in a high-tax state, tax is the most important driver of investment performance because depending upon how you set it up, you could pay as much as 50% in taxes or as low as 0%. Makes a huge difference, and people just don't realize that, and the financial institutions won't talk about it.
Why do you think that is?
Well, because first of all, it's hard concept because there's a lot to it. I ran TurboTax for 10 years, and there is a lot to the tax code, unfortunately, but that's what we have to deal with. The second thing is that in order to help people with their taxes, you really have to go on an individual by individual basis, looking at the tax lots of their portfolios. And somebody who's running a mutual fund or an ETF or something like that, you simply cannot do that.
So what are some of your tax planning tips, especially as many people, as we have just a few weeks left, several-ish weeks left here in 2024, they're looking at 2025 and saying, all right, what do I need to start to get in order to be ready for the next tax filing season?
Every year I produce a book called The Investment Tax Guide. We talk about 10 top tax strategies. But for December 31st, there are two things you really ought to pay attention to. First of all is capital gain. Capital gain is the best kind of earning to have, because even if you do nothing with it, it's only a 20% top tax rate as opposed to 37% federal top tax rate. But in addition to that, you can offset, you can defer, or you can even eliminate the taxes. Now, how do you do that? If to offset, that's tax loss harvesting.
Yeah.
So you want to do this before December 31st. You want to see what your losers are, sell them, because then you have tax loss that can offset. You can sell the gains and pay zero taxes. That's offsetting. The second thing is deferral.
Yeah.
And so tax gain deferral, first of all, you just push it in, don't sell a gain until next year.
Sure.
But in particular, never sell anything, or almost never sell anything, within 12 months of when you bought it. Because then it's a short-term capital gain, and you pay as much as 37% federal as opposed to the 20%.
Are there tax-advantaged accounts that investors should consider?
Yes, and that's what I really focus on, because there's a heck of a lot more that you can do as an investor than you can just with salary or bonus or something like that.
Yeah.
And so I'll give you another one. We're still talking about capital gain. You can actually eliminate tax on appreciated securities. How do you do that? Create a DAF, a donor advised fund, which is a gem of an account. Works beautifully, and almost nobody has one. What it allows you to do is take appreciated securities that you would otherwise pay capital gain on, don't sell them, put them into a donor-advised fund, and you never pay the capital gain. Now, it's in a charitable environment, and you no longer own that money. You can't use it for yourself, but you can still direct where those contributions go, and you don't have to do that today. So you can contribute today, get the tax avoidance, and then decide some other time, whenever you like, how much and to whom you give the money.
Bill, just lastly while we have you here, I mean, there was a surge in short-term or momentum traders or day traders even in 2021 and even over the pandemic, especially as people had more time. They had money from stimulus checks as well that they were deploying towards some of those accounts. Things have changed a little bit more, but it still seems like there's a fair amount of new day traders or short-termism in the mindset of retail traders out there. You actually advise against this. Why is that?
Don't do it. Don't do it. If you trade frequently, all of it is short-term gain. And short-term gain, you're immediately to ordinary income rather than capital gain tax rates. And that can be as high as 37% federal. And then you add 3.8% for the net investment income tax. And then state tax on top of that.
So you have to make sure your gains actually outlast all of those, or outpace all of the percentage taxation that you're
Yes, I mean, it's very, very hard to time something. It's appreciated, now I'm going to sell it, but I'm going to take that kind of tax hit. It's unlikely that the return is going to beat the tax burden.
To offset the burden, yeah.
Yeah.
Bill, great to have you here in studio with us. Thanks so much for the time.
Hey, my pleasure.
Really appreciate it. Everyone, switching gears here, we're seeing a lot of movement in healthcare stocks today. Weight loss drug makers, they're on the move as competition in the space, as well as a proposal from President Biden to cover these drugs in Medicare and Medicaid plans. But with the new administration taking power in less than 2 months, what do consumers and investors need to know about President-elect Donald Trump's picks to lead our health departments? Here with some insight, we've got our very own Anjali Kamlani. Hey, Anj.
Hey, Brad, thanks. I mean, we already know, of course, about RFK Jr. and Marty Makary for FDA. But what we saw was two new picks on last Friday. We got the CDC pick, which is former Congressman Dave Weldon from Florida. And then we've got Dr. Jeanette Nashewat from a Fox News contributor for Surgeon General. And these two picks are pretty interesting because of their stances, as you can see on your screen. Former congressman really is supportive of the anti-vaccine stance that RFK has, and also has a stance on anti-abortion, doesn't support that. This is interesting because of the global stance and position that the CDC has, the stage that it enjoys. Meanwhile, Surgeon General, less of a controversial pick, someone who has supported vaccinations during the COVID pandemic and seems to have a little bit more of support from the scientific community. Interesting to note that under RFK comes 3 doctors, or at least medically trained individuals, so that's a really good news. Meanwhile, we look at, of course, RFK. We've covered his stances on vaccines, ultra-processed food, and then global public health funding. This ties into, of course, Makary, who is going to be part of the FDA as well and oversees vaccines, oversees the processed foods. And he is also actually the chief medical officer of a telehealth platform called Sesame that offers compounded GLP-1s. As you mentioned earlier, something that the current administration is trying to tackle in terms of greater access for government funding and government payers. So tying it all together, something to keep an eye on, in particular, something I want to bring up, the FDA and CDC picks, along with RFK, are going to have outsized global influence. That's something to really keep in mind because that reflects on what's going on here in the country. We've seen in Trump 1.0, as it is now being referred to, some of the moves that the Trump administration made then in terms of pulling back public funding for global health needs, and that could continue into Trump 2.0. So there are some experts that are concerned about this. What does that mean for us? It means that in the US, we enjoyed this sort of level of privilege where anytime the FDA or CDC said something, other countries would tend to follow. And experts say that's in danger. So it means that even at home, on our home base, what advice comes out and what regulatory decisions come out for the average American, whether it be advice on certain diseases, communicable diseases. We know there's bird flu that's also being watched, and then of course the vaccine front, but other drugs, that's going to affect our everyday lives. And so it's going to be really important to take note of what's coming out here, as well as other countries like Europe, and how those decisions differ. So definitely some everyday but nuanced look at how this is going to really impact everyday American life.
Yeah, we'll see what the continued evaluation of these picks looks like and how.
If they're confirmed.
If they're confirmed, and of course, where we see some voice also from the largest medical and healthcare and, of course, the largest biotechnology companies out there as well. Anjali, thanks so much. Appreciate it. Coming up, everyone, we've got your Yahoo Finance Market Update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours into the trading day. It is time for Yahoo Finance's market update. The S&P 500 moving higher today, looking to hit a new high at the close. Taking a look at where the Dow is, down about 0.3% right now, as well as the Nasdaq up about 97 points. 3 trending tickers we are watching. The big 3 automakers seeing steep declines on the day. Shares taking a hit after Donald Trump threatened to slap tariffs on imports coming in from Mexico and Canada, in addition to China. We are watching shares of retail giant Nordstrom under a bit of pressure ahead of its quarterly results. That stock hit a 52-week high Monday, despite a cautious outlook for retail this holiday season. And analog devices coming off the highs of this session. The semiconductor stock seeing a big swing here, now down nearly 2% after it beat Wall Street estimates in its most recent quarter. The company attributing its growth to a pickup in orders in the automotive end market. That is your Yahoo Finance market update. For more on what's trending, scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. More wealth when we return.
Thanksgiving dinner isn't just about the several helpings of delicious, nap-inducing food. It's also about those sometimes awkward conversations with extended family at the dinner table. But with a few tips from my next guest, those money conversations don't have to be so painful. Joining me now, we've got Valerie Galinsky. She is the head of the Merrill Center for Family Wealth. Great to have you here with us today. You know, as we think about some of those money conversations that the family table and the dinner table may be having, where should perhaps it kick off? What's a safe entry point?
Yeah, absolutely. Great to be with you, Brad.
For us, a lot of the unintended consequences or the awkwardness that can come from conversations is when they're not planned, right? When there's not a lot of thought given to intent. So for us, whether the conversation is around gifting or some uncomfortable kind of, question from maybe an extended family member or a nuclear one about what someone's plan is, having a sense of intent and also an elevator speech ready, we found to be incredibly helpful.
And so with that in mind, let's walk through some of the scenarios that might play out. And I know that there are a lot of friends, some people in our newsroom, myself, other people who are making their way, traveling, perhaps meeting families for the first time and trying to say, hey, this is what we've been working on. This is what we've been navigating through. And it's great to meet you all. And here's the financial future we're preparing for as well. How do you start those conversations?
Yeah, absolutely. So to the point of elevator speeches, when we surveyed over 300 ultra high net worth families, and we actually asked them directly, have you regretted talking about money with a family member? 26% of them said I have. When we dug deeper, again, we found that 78% of those respondents said it was because it was spontaneous. So in terms of practical tips, if the conversation, for example, is around gifting, right? And there was a gift made and it feels, for example, there's some gray around intent or kind of what are you planning? And maybe there's a sense of expectations there. Again, trying to plan and structure it as much as possible in terms of saying, this is the intent. We are grateful. Gratitude is a really tough thing, right, to find fault in. And then having the communication that you feel comfortable with is really, really important.
What are some of your tips for couples as well?
Yeah, absolutely. So the thing that we find with couples, and we actually just wrote a white paper about this called Prosperity and Partnerships, is that at the end of the day, we all have different money messages growing up. And exactly to your point, whether you're meeting maybe someone's family for the first time or you've been together for a long time, everybody has judgment and has different perspectives on it. So the one thing that we really advise couples to do is get on the same page in terms of how they're framing, whether it's a conversation about gifting or a request. Sometimes we have families tell us, we're talking about a loan or maybe a charitable gift, and there are different perspectives around it. So having, again, clarity of communications going into it and also being able to anticipate some of the questions and address them, or really just say, I'm happy to talk about this, right? This is a nice holiday dinner. I'm happy to have a follow-up conversation. So as not to dilute it, we found to be really, really helpful as well.
How can family members share tips about how to combat things like their credits, how to make sure that they're paying down different expenses and debts that they may have as well, and even a term that might get tossed around a lot and perhaps overused at the dinner table, inflation, especially as many people are, charting their way to get to a dinner table or know how much is going into paying for the dinner as well.
Right, and no, very valid. And I think, again, it goes back to intent and expectations. So for us, kind of money-related conversations, and we were just kind of with the family, right, where the daughter and her husband were saying, I'm feeling a lot of judgment potentially from my parents when we talk about plans that we have. I think being able to distinguish between this is what we believe, these are our values, this is how we're choosing to make financial decisions, and mom and dad, in her case, I'm open to your advice on this element of it, right? So you are wiser, older, you've been through this. I would like your experience with maybe how to manage this versus telling us how to necessarily make financial decision is a really important distinction.
And to the extent that it's on the table for discussion, how should families be talking about or perhaps prepping the conversation for wealth transfer?
Yeah, absolutely. So what we hear consistently about wealth transfer is a lot of times from the parental standpoint or often wealth creator standpoint, there's a lot of fear or uncertainty about, I don't want to share too much, I don't want to impede motivation. And then we hear from the children, oftentimes young adults, I'm really uncertain of how to bring this up because I don't want to be interpreted as entitled. So for us, we really think about it as not a light switch of you have to share everything at once, but as a dimmer switch. So starting with what is the intent before getting to the structure in dollars is really important. And practically speaking, right, for parents, that could be saying, we've been doing a lot of planning. We know everyone's getting older. This is how we see success for our assets. Maybe it's to empower you, but also to give charitably. And likewise, from the rising generation or the children's perspective, really saying, I really want to understand what your wishes are, right? So I can carry out your intent and so I can make some planning decisions for my own life if there's some gifting or so forth that's going to impact.
Valerie Galinsky.
So it's really, again, the focus on purpose that we found to be really critical.
Absolutely. Valerie Galinsky, who is the head of the Merrill Center for Family Wealth. Thanks so much for taking the time here with us, Valerie.
Thanks so much for having me. Happy holidays.
Happy holidays. As consumers shop for gifts on Black Friday this week, they'll be hit with a lot of different offers to open new credit cards, many of them from the same retailers where they're buying their gifts. But a new report from Bankrate shows that at least 50 of those stores, at least 50 retailers rather, they raised their APR before the Fed started cutting rates in September. In fact, the average retail card rate is over 30% compared to 21% for all cards. According to Bankrate, bankrupt discount retailer Big Lots raised its APR 6 points for a top rate of 36%. Others that topped 30% include offerings from The Gap, Nordstrom, and Lowe's. Here to break down what consumers need to know about these offers before they open a new card is Leslie Tain, who's the Tain Law attorney and author of Life and Debt. Leslie, great to have you back on the program with us and good to see you. So, as people are trying to figure out where they have the opportunity to open a card and where it actually makes sense, what is the overall kind of rule of thumb that they should keep in mind?
Great to be back, and thank you for having me. The rule of thumb for consumers really is to look at your spending habits. Where do you spend the most money, and how is your money best spent using different cards? The new rates are for introductory cards, those that are offering new cards. So if you're being offered those cards, consider whether it really makes sense in your spending habit to take on those cards.
Why would it make sense to get a card versus just be part of a rewards program that you might have for giving a little bit of data, but also still having that digital relationship perhaps with one of these retailers?
Rewards programs can be great, but you want to make sure those programs align, again, with your spending habits. If you're accumulating rewards that don't align with your spending habits, then you might find that there's a disconnect. So be sure that you understand where you're going to be spending this holiday season and whether it makes sense to open new cards. Remember, those enticements when you open a new card will hit your credit report, and that could bring down your credit score. So when you're looking at new opportunities and new offers, remember it's a new offer of credit. So you want to be sure that it is something that makes sense with your spending habits and where you are using your money.
How can someone determine if they're already in a good position to open up a new card?
The greatest determination really is based on credit. So if you have a great credit score, you're likely to get more offers at better rates. Rates are coming down. That seems to be the trend. However, the new offers have higher rates as introductory offers. It's very common when you see a 0% balance transfer. It's an enticement by a bank to get you to open a new card, and ultimately at the end of the introductory period, you'd end up with a higher interest rate. It's really important to read the fine print when you're opening new cards. You can open cards electronically or even call the banks, the retailers themselves directly and have a conversation. But know before you take out that card what the interest rate is going to be before, during, and after any introductory period, and on purchases or advances, depending on how you're using that card.
So as you're thinking about the amount of cards and the new card offerings, I mean, ultimately, how many cards do people need? Is there a good kind of gauge as to what you should be using each card for, and knowing that you have a card that is transactable for the purpose of getting more airline points, or for the purpose of getting a better rate and discounts on groceries or even fashion or apparel? What's that kind of makeup look like from your perspective?
Ideally, you don't really want to exceed between maybe 2 to 4 cards. I have had clients that end up in debt with 26 to 30 different credit cards. It's important to be able to say no. Just because they're offering you what seems like a good deal doesn't necessarily mean it's best for your financial habits and financial future in order to have that many cards. Understand if you're traveling a lot, then travel cards make sense. If you're using a card for household expenses, that might be an option where you get cash back. You really need to take a look at exactly where you're spending and what cards make the most sense. And sometimes those cards will make more sense at different times of the year. Some retail cards may make more sense this time of year when you're spending and buying holiday gifts. So balancing out the number of cards you have with the use of those cards does require a little thought into what am I using the card for? How am I going to be able to pay it off? And what's the benefit of me getting from that card if I use it?
Leslie Tain, thanks so much for joining us here today. Life and debt author and Tain law attorney. Good to see you.
Thank you so much for having me. Happy holidays.
Happy holidays. A programming note, on this week's episode of Decoding Retirement, host Bob Powell speaks to Melinda Coghill, the I-65 Medicare software co-founder, about navigating the convoluted world of Medicare. Melinda says that you need to be wary of advice from Social Security.
I really don't think Social Security is really living up to its mission statement right now. Social Security's primary mission is providing guidance on Social Security or to help with Social Security. Medicare is the secondary mission. I know it sounds crazy and it sort of breaks our minds, but you can't necessarily trust the guidance or what the Social Security agent is saying to you. Right. You have to double check it, which makes things even worse and more complicated.
You can catch Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. We've got much more on wealth after the break. You're watching Yahoo Finance. Checking in on the U.S. dollar, climbing today but pulling back from its intraday high here. The dollar gaining initially on President-elect Trump's vow to impose tariffs on China, Canada, and Mexico. And you may be watching your screen saying, hey, a strong dollar sounds good. And it certainly can be good. A strong dollar means that your money goes further when you travel abroad. It means U.S. consumers benefit from cheaper imports. But too strong of a dollar can come with some risks. Here with the story, we've got Yahoo Finance's Jared Blickery with the breakdown. Hey, Jared.
Thank you, Brad. They call it the dollar wrecking ball for a reason. And let me just show you the charts. I brought the Wi-Fi Interactive right here to the desk. So let's show what has happened this year in what's called the Dixie, the U.S. dollar index. And all it is a weighted average that kind of favors the euro and the pound more than we would if we were doing this on a trade weighted basis. But this is something that everybody's looking at. So here's the dollar index this year. And you can see we had this huge run up. About half of that was since the election. And this is presenting some problems for risk assets. And multinational corporations, they get about 40% of their international revenues from abroad, and a stronger dollar hurts that. But let me show you a 5-year chart and just show you technically we just broke out of this multi-year range. And that's giving some investors, some corporate planners here some some headaches here. And if this were to continue, that would provide additional pressure on not only risk assets, but on some other areas as well. And I should mention, I just sat down with Raoul Paul along with Sydney Freed here, our producer, and we were talking to him on Stocks in Translation about the potential for the US dollar to interfere in international relations. And it also has implications for countries that borrow in US debt. Let's take a listen.
When the dollar is too strong, we talk about the dollar wrecking ball.
Yes.
Because what happens is, in a world that borrows a lot of dollars, the dollar that's expensive means it's difficult to get enough dollars in the system to pay off global debt. So we've seen, for example, China's real estate sector. It's mainly a dollar borrower. When the dollar's expensive and they earn in yuan, it's difficult to pay the debts. So that tends to what happens when the dollar is high, and what it does is withdraw liquidity from the markets, because so much of your extra expenses are in servicing of those dollars. So when the dollar liquidity comes, it can start to slow the economy and particularly markets, but it is forward-looking. So the recent strength in the dollar and the strength in rates probably leads to some sort of market correction towards the end of the year, beginning of next year.
So you heard it here, maybe a little bit of a market correction as that dollar, that strong dollar kind of lags and influences the market later this year or early next year. Want to leave real quick with central bank policy rates around the world. This is another dynamic here. And we have on the very low end, central bank over in Japan, that's the Bank of Japan, their rate is 0.25%. Right here in the US, it is 4.75%. That's right here. And in other countries like Mexico, it's 10.25%, even higher. But these interest rate differentials throughout the world also affect U.S. dollars, strong dollar policy. So in brief, there's a lot to be done and a lot to wrap our heads around as we have this new administration, as we digest all of their new tariffs and all these other policies.
Jared, thanks so much for breaking this down, all of the movements and machinations around the greenback here. Appreciate it. And you can see more of Jared in Stocks in Translation, new episodes every Tuesday and Thursday at 8:30 a.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Everyone, that is it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.